Howdy, it's Mike again. We are doing our first part two ever. So, this is going to be part two of Follow Through Days, but also going to be combined with 21-day moving average, which is something that we also did one on, but it more focus on Follow Through Days, but blending in some of the 21-day in there. And you'll see it as we go along how they really go together. So, I'm going to make this so you can watch it even if you haven't watched the earlier videos. But when you're done with this one, I would certainly go back and watch the follow through day Webby Rambles on, as well as the 21-day, because then you'll get more context. But you should be able to watch this one as is without those and just have those reinforce it. And frankly, if I were watching these, I would watch them a few times. The first time I'd probably watch it just on 2x speed, just to, especially to get through my rambling part of just backstories and things that you don't really need the chart. Slow down to 1x speed or 1.5x speed when I'm going over charts. But then the next time you watch it, you would just know, like, okay, you just want to, do it 2x until it gets to something tricky. And then just maybe rewind and go to 1x. I hardly ever watch anything or listen to anything at a 1x speed. It just drives me crazy. It's just so slow, especially with my voice issues. I think it's better at 1.5 or 2. So let me just share with you the series if you don't kind of know where you should go with these. So how I would do it is I would start with the regardless of if you're interested in regardless of what you're interested in, I would start with the 21-day, which is this one, number 9, and or the number 10, the follow through day. So either order for those, and then once you get that down, then it's really what you're interested in. We're going to be doing more model book studies as part of this series. So I would start off, or me, I would start off with how to build a model book, because that's kind of your foundation there. From there, you can do in any order, either the model book study on Apple, the model book study on Cisco, or the Google one, which also is on one of my inventions, the IPO base. And then from there, just whatever is interesting, of interest to you. The last one we did was the how I developed the 3-month relative strength rating, how to use it. Also, number 5, the growth 250, how and why I developed it, how to use it, a kind of a catch-all for a number 6 of how I use market surge, because I'm sure, if you just want to know how I use it. Um, then also the very first one was on precedent analysis. This was really searching for times after the December 18th bad break that we had, and just kind of walking through the thought process there, how I do research. I don't think people are really watching it because they think it's probably only for that time frame. It's not at all. It's how to do this precedent analysis and what to look for, and it's still relevant to our current market. And then, of course, how and why I developed the composite rating, which was really Bill's go-to rating, and the one that no one seems to want to watch based on the numbers, but my absolute favorite is the one on fear, and that has nothing to do with stocks. It has everything to do with fear and how I've dealt with fear over life, and just some things I think that would be frankly helpful to most people, but there's no interest in it. It's okay. As I've said before, I'm putting these out there for free to help folks to try to speed up the learning curve, because learning how to trade is really, it can take people a long time. It can take you a decade, if you don't have the right tools or know what to do. And so this is why I'm honing in on the most important things, and to really help people get through that learning curve as quickly and as painlessly as possible. Now, I also have it for kind of the diehards that are like me, kind of geeks, and I want to have kind of higher end stuff. So I'm trying to touch on both aspects of them. So it's interesting to whether, if I were watching this, would it be interesting to me, or if I've, just started trading, you know, um, where my interest level would be. Sorry about the breathing and all that stuff. It is what it is. If you don't know who Bill is, Bill O'Neill, my mentor and everything, you should get this book. Is really, thought of as, in our world is, the foundation, the kind of the Bible, for lack of a better word, of this. I don't mean that in any bad way, but in a very good way. Like, this is kind of the foundation of everything, and there's everything you need to know about trading the system. Well, not everything. A lot of what you need to know is here, at least the foundation is. And then the other thing, where I get kind of all of my stuff is from Livermore, Jesse Livermore's work. So, Reminiscence of a Stock Operator and How to Trade in Stocks. Those are the foundation for what, and Bill liked those as well. But that's really my foundation. And then if you read those, you'll be like, well, there's nothing really technical in there, but you don't need technical stuff in there, because you can learn the technical aspect of things by looking at charts and testing out. But it's all the kind of the emotional aspects of the market, the fear, the greed, the hope that drives all the patterns. And that's what Livermore really, is the grandfather of that, in my opinion. So that's where I lean. And Bill did have a heavenly birthday this week, and if you've never seen him, here he is. I was just going through some old stuff I had, and that's good old Bill. I'm not sure how old he is there. He's definitely younger than I am right now. God, maybe he's in his 40s there. But anyways, of course, we all miss Bill. So that's a little bit of that aspect of things. So we're going to get into this. I'm not going to do a huge backstory at the beginning of this one, because we have so many charts to get through. And again, we're focusing on on follow through days underneath the 200-day. And as we go through, I'm going to throw my normal rambling in, but let's just get started. So here, again, this is what I do at the beginning of whenever I'm going to start talking about things. I'll wave my arms like this, because at the beginning of these, I tend to babble on quite a bit. And if this is your first one, just to let you know, I originally wanted to put something together for my kids, my twins are 23 now, and they're just not interested in the market, which is totally fine with me, because I've never pushed them to do anything. I've always wanted them to find their own way in life. And I just encourage whatever they do, as long as they're happy, I'm happy. And so if they ever come around to wanting to trade and I'm not around, incapacitated in any way, I wanted to have something there for them, because I knew a very famous trader. I'll just leave it at that, a kind of a legend, who asked me once to train one of his kids how to invest, because he never had the time growing up, and this person was an adult at this point, and it's a little bit unique when someone's a legend to that would be a lot of pressure. So he asked me to teach this person how to trade, and that was a huge honor for me, and something that meant a lot. And the person didn't know that I was asked to do that until, well. So, anyways, so that's what this kind of I was thinking about. It's like, wow, if I ever had dementia or something like that, if I make it that long, that I can't pass this info on, and if something were to happen to me, it's like, God, I've done, I've spent all this time working, and I wanted to leave something for my kids. So one of the things is, I was originally going to write a book when I left IBD in 2020, and but I really didn't want it to be something. And people had asked me to write a book, and I said, I need some time away from the firm um, because I didn't want to be riding Bill's coattails. I've created a lot of the intellectual property that I don't own. At William O'Neill and Company and IBD. A substantial amount of the intellectual property was created by me. And most people don't know that, and that's fine. It did. It was never a big deal. I would do stuff, or Bill would ask me to do stuff, and I enjoyed it, loved it. And I'm doing it again now that I'm back at IBD. This week was 1 year that since my return back at IBD, with the wonderful people there. And I'm just really enjoying trying to continue on his legacy, because he passed in May 28th of 2023. And that really got me thinking, like, I wanted to do whatever I could to help out IBD continue the legacy as if Bill were still with us. Of course, there's only one Bill. I'm not Bill. I don't claim to be Bill. I'm me. And I'm quite different, in many, many aspects. But I think I know how he traded, how he thought, more than anybody alive, frankly. And, I had all that info, and I wanted to be able to share it with people. And, so I came back, and so I'm on IBD Live every Monday, Wednesday, and Friday. And that's a lot of fun. It's a paid program. I don't get paid money, if a bunch of people sign up. So don't think I'm trying to sell anything. It is what it is. I do it. It's part of my gig, and it's a lot of fun. It's my favorite time of the day. It's 20 minutes before the open, and then we go for like an hour and a half ish or so into the open, and we just talk about the market. And there's always four different folks on, and different people on Tuesdays and Thursdays than I am. And then on Friday we always have a special guest that comes. So I always look forward to that, because it's nice to hear other people's take on the market, especially if it's really different than yours, because you learn a lot, and it either reinforces how you think about the market, or it will give you an idea to go down a different path. So that's what I do. And then, of course, on Friday for free, I do with my good friend Allie the SMT video, the IBD's stock market today video. And I take that very seriously. I spent a lot of time on Friday just focused on, like, what are we going to talk about, and what things I want to go over. And that's free on YouTube. It's on Spotify and all that good stuff. So anyways, if you want to watch more of me, if you're having trouble sleeping or something, you just want to be like, oh God, I can't get to sleep tonight. What does Webby have? So listen to one of my things. It works miracles. And of course, I'm not an investment advisor. I'm not registered on any level. This is not investment advice. It's really just to help folks out. And get your own investment advisor and all that type of stuff. But going back to the reasoning, I was thinking, like, if my kids ever got into it and I was not around for whatever reason, that I wanted them to learn something from me. I spent all this time figuring this stuff out, and I wanted to pass that on. And really, I'm not sure that they'll be that interested. I think most likely my son, because he's really, into poker, and he used to trade crypto a little bit and a little bit of stock. So he showed an interest there. So I have a feeling that he might get into this at some point, but he's so busy starting a career that it's probably not, anytime soon. But really thinking maybe in 8 or 10 years, they both have kids, and then their grandkids. So, I really like to look forward, and just think, like, 20 years from now, wow, no, I guess that would be really more like 30 years from now, this would be relevant for my grandkids. And, at that point, if I just put this, recorded some videos or something, put it on my computer, like, who knows what even computers will be like at that point. So I figured, put this out there. Probably a strong possibility that YouTube will still exist, or at least the videos of YouTube would still exist in a few decades. Just with all the content that's out there. And so I wanted something just, documented for them. And as I was saying, I was going to write a book when I left, but I didn't want it to be, this is what I learned from Bill, buy my book. Fuck that. Sorry. I wanted it to be my own stuff. And if I put Bill's stories in there, where they were relevant, I was happy to do that, but I didn't want to ride on his coattails because frankly, I've done my own thing, my own way. And I wanted to have enough time there before I started writing it. And I was going to start writing it, but then when I came back to the firm last year, I just got so busy with so many things, and I'm working on, redoing some ratings and working on pattern rec again, and a bunch of other things, plus my normal workload. And so I just won't really, frankly, have time to write a book. And maybe I'll take the best of these and put it in a book if I get that time. But I just didn't want it to be like my time with Bill and write that. I wanted to do 100% standalone, whatever I did, whatever I wrote, or whatever I hope to write, and just be just my own thing. And if no one buys it but my family, that's fine with me, man. I'm just trying to help folks. But I don't like riding people's coattails. That's just not how I roll. So anyways, with that said, God, I really had planned on just getting right into this without even any backstory, but I think that's pretty good. So here we go. We're going to get started with some follow through days. And probably the best thing to do would just be to start with our current market. Now I'm having these, I'm not recording these wanting it to be focused on current market, because that's what I do at IBD, and I don't want this stuff to kind of have any conflict of interest of what I do there. So, on IBD Live, I talk about the current market. On Swing Trader, I put out, swing trading ideas. And of course, Justin and I do once a month now. We do our Swing Trader update that's free online. And then, of course, on Fridays, I do the S&T with Ali that I was talking about. So those are all current stuff. So if you want to know my current thoughts on the market, you can find them there. But these are more for the things that don't have time to do at work. And frankly, no one would have the patience to hear me just babble and ramble on. These wouldn't happen if I did it under the umbrella of IBD. So I just wanted, to just do this in my free time. So here's our current market as we stand right now on March 28th, 2025. And we just had a failed follow through day in Spirit. And so I just kind of want to walk through that. And then we're going to look at some historical, or actually a lot of historical examples, focusing in on the follow through day after you make it through the 200 day, which is this black line. Dang, man, this cough just will not let me go. Okay, so here is the NASDAQ as a point of reference. The green line is the 21-day exponential. The red line is a 50-day simple. And the 200-day is, or the black line is the 200-day simple. And we're coming down in the market. We're underneath the 200-day, and you're looking for a follow-through day. This was not a pink day rally day on 3/11. Let's just go there. Kind of walk through this whole process. So here is not a pink day rally day because we close in the lower half of this day, but this becomes your low of the rally. Your first day in your rally attempt looking for the follow through day is this day. So this becomes day one. This becomes your low, or day 0, 3/11's low. And so what we're looking for, and just to kind of see, and just stop sharing for a second, just to kind of back up and understand, just a review. I went over all of this in the first follow through day, but just if this is your first time, just so you understand, a follow through day is a system that Bill came up with years ago, decades ago, to get you in the market. And it's the first sign that the market trend, the current trend of down, is changing, is not magic. About half of these will fail. And you'll see that as we go through. And it's very important. That's why I'm doing this, because people think this is this magical thing and they use it the first few times and they get burned and they're like, well, I'm not going to do that anymore. I bought on that follow through day and I got chopped up. Well, that's the way it works, man. If you're in a downtrend, no matter what you do, you're going to get chopped up. So what this does is it minimizes the risk while you're in a downtrend where you're only buying for a short period of time if things don't work out. So it gives you a signal to of when to start buying and when to change your mindset from being negative and fearful to optimistic and hopeful. So when you're in a downtrend and you don't have a follow through date, you should be very fearful that it is going to continue lower, because it will continue lower until it stops. I mean, that's just how it works. And then when you get a follow through day, knowing that about half of them will work, you have an indication that, okay, I'm going to start getting back in the market, and I'm going to start changing my mind into being offensive. And so what, the famous thing is Bill would always buy something on a follow through day, because even if he was in cash, if you have a follow through day, it was to buy something. And I've bought on every single follow through day ever, even when I was pretty sure it was going to fail, I still wanted to force myself as using discipline to make sure I bought something. But you don't have to buy a lot. You can buy one share of one stock, that's enough. Or you can go super deep if you're willing to back right out if that thing fails. Because if you go super deep and you don't have it's kind of like driving a car. Sure, you could drive a car super fast over the speed limit, but you better be able to, maybe you can't drive 55, and you better be able to put on those brakes right away, because otherwise you're going to crash and it could get really ugly. So with that said, that's what the follow through day is. Now we'll also during this talk about the 21 day, which there's that video on. And with this one, we're going to be focusing on the low being above the 21 day for 3 days or more and closing up on the day. Just one of my things, not a Bill thing. This is one of my things. It is extra confirmation that it is for real, and in some cases, an alternative to a follow through day. So again, just to recap, you're coming down in the market, you're looking for some sort of signal to get in. So you hit a low, and you know it's a low because you don't go below it. You have a rally day, meaning you're up anything. It's just a blue bar. That's your day one rally. Now, if your lowest low happens and you rally that day, and we define that as closing in the upper half of the bar, so a 50% closing range or higher, or really of the true range if there's a gap involved. So you look at the prior day's close if there's a gap. And you want to be in the top half of that. And we call that a pink day rally day, or a rally day number one, where then your low is the same as your day one. So that's just the counting. And if that's confusing at all, it won't be once you see a few charts. I'll just point them out. So that's to just start counting. And you're counting because you're waiting for this follow through day to happen. And follow through day is just another big up day that is telling you that, yes, that low, you've held that low, and now you have further strength. So this might be for real, and then you start acting on that. So that's what the follow through day is. And in general, it's either in normal volatility environments, it's a 1% gain. The orthodox way of looking at it, the way Bill would look at it, is volume has to be higher than the prior day. I don't use volume at all, so it doesn't matter to me. But everyone else, including Bill, would use volume higher than the prior day. It's not that I don't think volume is super important. It's just that, as I discussed in one of the earlier episodes, and I'm not sure which one that was, that I believe volume is dirty data. So, in very dirty data, like every year it's getting dirtier. So I don't use it, because otherwise it will throw you off, in my opinion. So if I've decided something is dirty data, I don't want to be like, oh, okay, I'm going to use it when it makes my case. I'm bullish and I want to follow through days, so then I'm going to use it. Or if I'm bearish, then I'm going to say, oh, well, the volume wasn't there. That's just intellectually dishonest, and that's not how I roll. So I just said, you know what, no volume, no matter what. If it's not clean data, I'm not going to use it. And there's simply no way that anyone could possibly prove that volume is, especially consolidated volume on a index level, is clean data. It is just impossible. I could argue that with anybody, but it would take hours and hours and hours, and someone would have to have an open mind on the other end. So it's such a big topic. It would take me 10 episodes to really convince anyone, and who's going to listen to me? Like, it would be people would listen to me who have already kind of the mindset that volume's dirty. No one on the other side. So it's pointless. I don't want to waste my time nor yours. So, but from an orthodox standpoint, volume has to be higher than the prior day. It does not have to be above average. Bill never said that it had to be above average ever. Now, he would prefer it to be above average, but it only had to be higher than the prior day. And in fact, even if it was the same volume as the prior day, the same exact volume, and that wouldn't happen later in life, but early on when there wasn't as much volume, that it was in greater than or equals to. So as long as it was the same as a prior day, that was enough for him, if you're curious and you're studying historical examples. So anyways, you come down, you're looking for a signal, market hits low, and then you're waiting. And his waiting thing was he wanted it to have some cooling off period between day one and when the follow through day was. And so he would look on day 4 or after. There's a whole thing about a third day follow through, and that would really need a separate whole separate podcast on that one, and that's not for today. So on day 4 or after, you have this big move up, 1% in normal times, 1.25% in higher volatility times. Right now, it's at 1%. So like think 1.25 back when you're in like 1999 or 2000 or even 07, times where the market moves around a lot more than it currently does. So that is your follow through day system. Now the rally is over when you actually undercut the low. So either if it's a pink day, rally day, you undercut that low, or if you had your rally day, which was above the low, when you ultimately close below your low, or actually intraday even penetrate it, the rally is over and you need to start again. So that's that. So let's see. Let's get into some charts again. Well, that was a relevant backstory. It wasn't like just me babbling on. So here is your day 0. That's your low. So the low of this day is what needs to hold above. This is your day 1 of your rally. This is day 2. It's meaningless as long as it holds above this, which it did. We're still counting. Now you back up. This is day 3, okay? Day 1, 2, 3. So you can't have a follow through day there, even though, that was pretty convincing, a 2.61% move. And the only reason why that wasn't a follow through day is because this closed in the lower half. If that had closed in the upper half, that would have been day 1, and this would have been your follow through day. But rules are rules, and so let's go forward a day. So not up enough, only up 0.31. You can see that up in the top corner there. Now it's back down. Okay. It's up 1.41%. So, at this point, the volume is less than the prior day, but I wouldn't even, that one's debatable whether you want to call that a follow through day in spirit or not. Just the position of it is weak. So when I look at something that doesn't pass, that's a whole can of worms. I could do a whole episode on this. So for right now, we'll circle back to that in another episode, and maybe I'll do one just on follow through days in spirit. But that's not really in a normal position. If it would have closed up here, I would have considered that a follow through day in spirit, because you're closer to your high. This is kind of a weak position there. A nothing day. Now this was a nice upside reversal. So if you're swing trading and you get something like this, not not a this is not normal. This is not a follow through day. This is not anything part of the system. But what I do and what I did on that day was bought a bunch towards the end of the day, because now with an upside reversal, meaning I'll just blow this up even more. You've got a big spread closing at your highs, and you've undercut a recent area of support. Now, this isn't a huge upside reversal, because typically an upside reversal would be more like this day. Let's go back to 228. Like that's a classic upside reversal where you've kind of had a mini capitulation. You've closed below all your recent lows, and you find support somewhere, which in this case is the 200-day, and you close at your highs. That's a beautiful upside reversal, and that's something I would buy on there, and then I would use the low of that day as your exit. And let's see what happened here. That was what we call an expectation breaker, a term that I came up with Justin and Chuck when we were doing the market school rules. But it completely broke your expectations. An outside day, your high is higher than the day before, your low is lower than the day before, and you close below it. I mean, that's a really, really, really significantly bad day on every level. And it really broke your expectations, which is why we call it an expectation breaker. Kind of logical there. And so let's move forward. Where were we? We were on this day. So we've got a triple witching Friday, which becomes important in a second, but you close at the high. So what I do when I'm swing trading and I'm in a position like this, I'll go ahead and buy. And sometimes I'll buy a fair amount. And because now I'm using that low as my exit, not part of the follow through day, nothing at all, but it's just a swing trading thing that I use. So, because your expectation is something like this. So this was your follow through day in spirit. And let's walk through how Bill would have called this a follow through day. I heard a lot of things on Twitter and stuff. It wasn't really a follow through day. Bill wouldn't have called it. Well, the reality is, for about 15 years, I called every follow through day with him, as well as any key distribution days, because that's what we did together. And so I know how he thinks, and he would have called that a follow through day, and I'll tell you why. Okay, so one, when he would use his judgment for things, he would want it to be like very, very clear cut, like this day up 2.27%. You're at highs for your rally. He wouldn't use the 21-day, but for me, that's just an added thing where it closed back above its 21-day, and you had this nice gap, and of course closing at your high. So it had everything going for it, way more than what you needed. We only needed a 1% gain, and you get a 2.27%. So you have to take action on that if you're following the system, in my opinion, because what we did, I'll just stop share for a sec. What we would do, because Bill would watch distribution, which we talked about in the follow through day episode a lot. He would watch that like a hawk. Like distribution was a huge deal, as big as a deal the 21-day is to me. Distribution was to him, so he would watch it like a hawk, especially when it was at an important level, like we were at a maximum level of distribution in a short period of time. So I built something for him in Wanda, which was our institutional version of Market Surge, that would show the same what the volume was at the same time the prior day. And even though he had access to it, for whatever reason, he would just call me up, throughout the day, and it would only report on the hour, the first half an hour, and then every hour after that. So shortly after the hour, he would call me up and Mike, how's volume running? Does it look like it's a follow through? Does it look like it's a distribution day? Whatever it was that we were looking for. And then we'd go through certain stocks or whatever, talk about it, or sometimes it was just a quick phone call, 30 seconds. No, volume's less, click. and so he was watch it like a hawk, and so would I. And because back at that point, volume I considered volume clean, um, but then over time it became dirty, in my opinion. And so we would watch it, and then on key days, like there was one day there was a Columbus Day holiday. So there's certain days out of the year where the bond market closes, but the stock market is open, and that creates a natural low volume day for stocks, because lots of things are tied to the bond market, like lots of algos and discretionary players and arbitrage folks, and all sorts of things are tied to the bond market. Even though we don't really talk about the bond market, it's a big important thing out there. I mean, most of the money out there is in the bond market, so it's a big deal when that's closed, and so you get this dry up in volume. So when we had a follow through day once on Columbus Day, he just called it, because he said there's no, he used his judgment that there's no way that you could have had higher volume when it's a pseudo holiday. He would do the same thing, Veterans Day, which is a big deal for me, that the New York Stock Exchange stays open on that day, but yet the bond market respects our veterans. So New York Stock Exchange, not a fan of you these days, and NASDAQ, like, come on, if you don't value our veterans, um, well, you just don't. Frankly, you just don't, because you're open on that day, and it's frankly rude and disrespectful, and there's no excuse for it. And anyone who's watching from the Nasdaq or New York, I mean, feel free to call me. I'd be happy to explain to you how ridiculously rude it is. The all the other days that we close on, and we don't close there. Anyways, sorry for that rant, but it really pisses me off. So, like the day after Thanksgiving, for example, is always a half day. And so the market only being open for half day, like, how do you really do volume there? Because there's no comparable. So he would adjust. But why I call it a follow through day in spirit, or something in spirit, is when a spreadsheet wouldn't pick it up. So with the market school rules that I always talk about, Justin has this master spreadsheet, and it's just, it either is above it or it's not. Like, there's no touch of gray in there. But in the real world, there is a big touch of gray, and so that's whenever it's that gray zone where a spreadsheet or maybe my pattern rack or something like that wouldn't pick it up. I call it in spirit, because it's like, what are you really after? Are you after this concept, or are you after these rules that on some level are data fitted? No matter what you do, you're either subconsciously or consciously data fitting anything, right? It's on the data set that you have, and you're developing rules. So I try to step away from that and say, okay, what is the concept of a follow through day? It's that you hit low, you had a cooling off period of time, and then you have another thrust higher. So does it really matter a very specific threshold? You're trying to get this market turn, and your rules, you have defensive rules to protect you for when it's wrong. So even if you had a very high level saying, volume had to be above average, you had to be up 2.5% on the day, it had to close at the highs, volume had to be 10% higher than the prior day. Like, you really make it very restrictive for a follow through day, you're still going to have a bunch that fail. So you either decide, when you're looking for follow through days, you either want to be inclusive or exclusive. So exclusive are folks, to me, who haven't really studied it. People who say, oh, it's got to be, they make it as hard as possible for a follow through day to happen, whether it's volume related, whether it's the percent gain, or anything else, because they hate when follow throughs fail. But the thing is, what can happen is your favorite type of follow through could happen on day 17, whereas your follow through day in spirit could have happened on day 4. So from day 4 to day 17, you could have been sitting there with FOMO this whole time. And that's where the danger comes in of, if every day the market goes up without you, and you're sitting on your hands going, I'm waiting for a follow through today, I'm waiting for a follow through day, that pressure builds, right? Because we're all emotional. Like, anyone who says they're not emotional, they're just lying to themselves. That when when that time happens, because I've been there, done that you're going, oh man, I can't wait to buy, I can't wait to buy. Then when the follow through day finally happens, the real one, supposed real one, then you just plunge in because you've been waiting, and those are the ones that typically fail like right away. So I rather be inclusive and say I want the lowest possible threshold for everything, because I want to get in as early as possible. Because, and I'm going to walk you through that there's a way to get out gracefully um, when they fail. So why wouldn't you want to be inclusive? It makes no sense to me unless you frankly just haven't done the work. Because we've studied it and found that, I mean, there are times where sometimes the follow through day didn't happen until like day 28. Those are trading days. So that's almost, what is that? Almost, 6 weeks that you're sitting there on your hands. And you might have had other signals in there if you're using the follow through day in spirit. So that's a little bit on that topic, because it just cracks me up. I see people like, oh, the volume wasn't there. The volume wasn't there. So let's go back through why the volume wasn't there. Let's see. Making sure that I'm sharing this properly. Okay. So let's look at the intraday chart. Oops. Gotta go to the current day, because this failed, but I want to just see on the 24th. Okay, we're going to go to the intraday. Where's the 24th? That's the 25th. Okay. Yeah, maybe I was looking at the date wrong. 24th. Yeah, 24th. Okay. Huh. That's very strange. Oh, just my eyes playing tricks on me. So anyways, so here's your I'm sorry, I'm still asleep. So here's your big volume. This is a 10-minute chart. And this is the day before the follow through day. That was throwing me off. I apologize. So you have all this normal volume all day long, right? And volume is like a U. You have a big volume at the beginning of the day, dries up in the middle of the day, and you get big volume at the end of the day. That happens every day. You can just see this here. Volume is U-shaped. It is what it is. It's always been that way. Probably always will be that way. So in this last little bit, you have the triple witching volume that came in. So this massive spike. So there is no way for this. You see, this is only 106 billion. This is 330 billion, all just in that last little bit. And so it's a technicality. It is, so on this day, the 21st, which was that Friday, that was your triple witching. So you get this, look at that big volume spike. There was nothing special about this day to make that volume spike other than it being a quad witching. And so that happens or triple witching. That happens 4 times, a year. And you get other volume spikes when, the Russell rebalances, the S&P rebalances, not sure what it was on this day, this weird volume spike, or this weird volume spike there, like that was probably the Russell rebalance, like these weird days that end up happening. Or so here's like the day after Thanksgiving. So how could you expect the day after Thanksgiving, when everyone's shopping and everything, to have volume higher than the prior day, and you're closed early? So this is why I use the in spirit. And it's just frankly disingenuous of people to say, oh, we didn't have volume this week, so therefore that's why it failed. That's not why it failed. It failed because it failed. Nothing to do with the volume. So your volume was in theory higher because it was higher everything until we were watching it until like the last 10 minutes or something, higher than your prior day. So the volume was high enough. And also don't listen to that silliness about the volume has to be above average on the follow through day, because just study them. That's just not true. So we have our follow through days. So you have to switch gears and start playing offense and buy stuff. And so I was buying the day before and then adding to it on that day. And I was in the back of my mind, I was like, you know what? Such a strong possibility of failing because we're underneath the 200 day, which is what we're going to be talking about today, and underneath a very sharply declining 50 day. So the odds are really stacked against us, but you still buy regardless. So let's go forward a day. Next day, everything is fine. A tight little day. I call it kind of equilibrium because you're not going up a bunch or down a bunch, and so that was very impressive and happened to trade at the close of the highs. What was a little odd there was the S&P 500 at that point had just gotten above the 200 day, and normally when you get above the 200 day, it should really kind of thrust up because you've got a lot of shorts that are being squeezed. So that was on the S&P, that was a negative sign because that was abnormal, but not abnormal enough to back away. So then let's just go forward a day. All right, so it fails. And that happens. It's just like would you not buy breakouts because half of them fail? Well, actually more than half of them fail. About 56% of them fail on average, based on a huge study I did. So, yes, you're still going to buy them because you have an exit plan. So again, what we came up with, back when we were doing the market school rules, is we came up with a new rule that Bill hadn't developed. This was one that I developed with Chuck and Justin. It was funny. I heard last week, maybe 2 weeks ago, someone quoted me. They're like, "Oh, so and so has this study where the close below the follow through day, blah blah blah." I'm like, that's our rule. We came up with that. So that's another reason why I'm doing these, is because and this was somebody I work with, didn't even realize that we did it because I just don't. I've never tooted my own horn or anything, and I didn't, and I still don't want to do that. But again, I'm just trying to leave something for my kids to know what I did contribute to this little niche of the world. And so what we found was, this is your first sign that the follow through day is going to fail if you get a close underneath the low of the follow through day. So here is your follow through day on the 24th. Now you close below it. Now it's debatable because you had a gap on there. Did it really close below it? And Justin and I did study the small sample size of these, and it didn't seem to make a difference whether you use the full true range, meaning Friday's close, the 21st, or the trading low. And so I opted to use the trading low of that day because it will get you out faster, and you can always buy things back. So it's really no harm, no foul. So technically you're buying there on the follow through day and you don't make a lot of progress. So you're not getting in too much deeper. And then you have to back away on that day because it's failing. And that's how a follow through day works, and how when it doesn't work. I mean, I said that wrong. So this is how a failure of a follow through day works. You get the follow through day, and then a close below that, that's where you're exiting. And that's why we like buying them there, because if let's forget the buy that I bought here with the upside reversal, which I would have used the same thing, the low of that day as your exit. But with a follow through day or a follow through day in spirit, if that's your low, you're not taking on that much risk. Whereas any one of these days, whether you like to buy on random day and any up day, any the second up day, whatever you want to use, nothing really works better than this on a bar basis. I prefer the 21 day, but it's we'll get into that as we go along. So anyways, that's how these fail. Now, obviously, if it continued higher, then we would when we see those examples, we'll just walk through how you increase exposure. But this is, reminder, you hit if you kind of zoned out because I was all over the place. Here was our low on this day here on the 11th. That was your low. You need to hold above this low to be still in this rally. Then you're waiting. Then you have your day one rally, and you're waiting on the fourth day or after. So day 1, 2, 3, 4. So from this day forward, we're looking for a big up day. which we're currently defining as up 1% or more. And then, of course, on a normal day, you want the volume to be higher than your prior day. So that's that day. And then you exit when you get a close below the low there. And how we came up with that rule was when we were building Market School, we would see these times like this where we knew that like there's something, here's your follow through day here, and it fails. But originally, you didn't officially know that it was over until it came under the 17238, which is that low, and that was a long way down. So you're buying here, and you're saying you're not going to exit it till there, and we just thought with this risk model that we're doing with Market School rules that that was just like not ideal. Like that was terrible. Like because in some cases it can be really a mile down there. Let's say you didn't get your follow through until up over here. Are you going to wait for it to come all the way down there? That's not risk management. So we wanted to look for something else, and we just did it with an open mind. And that's what I really enjoyed working with the guys on, is we would just look at things and with an open mind, and we'd get an idea and we say, well, what about this? And then we give it to Justin. He'd put it in a spreadsheet, and he'd come back, and we'd look at the results and or then go and look at all the examples of it. It was a ton of fun just thinking outside the box. And so that's the follow through day. Now let's just go to the current day just for fun. So now at this point, I tried buying some here intraday when it was looking like an upside reversal. And then I had to back away first thing in the morning because it was undercutting that. And I did not want to stick around, because once it undercut that, when, it was fading, it wasn't an upside reversal by the close, but intraday when it was up here, it looked like one. And then it came down here. I'm like, no, you got to get out, because this looked like a magnet for here, just having studied this. So we got out of Dodge as quickly as we could on Friday morning. So we'll see how that plays out next week. It's like Forrest said, life is like a box of chocolates. You never know what you're going to get. We never know what we're going to get next week, but man, that looks freaking ugly, man. I mean, that's what they look like before bad things happen. All right. So that's the kind of the what a follow through day, the procedure of it. Now let's just kind of step back. We're going to take a step back moment and look at, before we get into the historical examples, and just look at the NASDAQ history on a monthly chart. And what I did is I put a 9-month bar on here, because 9 months is as close to a 200-day as you can get. Like, it's like between 9 and 10, or 8, 9, or 10, and 9 is the closest that you can get there on a monthly basis to equate with a 40-week or a 200-day, because there's something very special about a 200-day. Let's go back on a daily chart, and that's that black line here. Okay, I'm just zooming out just so you can get a sense. Don't worry about the little bars, but just kind of focus on what we're seeing here with the 200-day. When you're above the 200-day, you tend to trend up. When you're below it, you either get choppy or you tend to trend down, and sometimes both. Choppy and down there, trend on your way up when you're above it. And again, it's this black line. And now that we're below it, it's kind of a danger zone. And you can do that like on a monthly basis. You can look at this 9-month bar and just kind of see how big of a deal this is. Being above it, good things tend to happen. Above it, good things tend to happen. Below it, bad things tend to happen. And these can last for a long time. I mean, look at this 07 to 09 down here, 2000 to 2002 over there. Historically, you don't spend a lot of time underneath that 200, or in this case, the 9-month bar. And let's even go, just going back in time, let's do a change date to 2000, just so we can get more history on here. you can just see, back in the 73, 74 bear market, how bad it was, and you're underneath your 9 month almost the whole time. Then when you get above it, good things tend to happen. You got some little blips in here. Here's the 1987 crash right there. Some time here in 1990, but most of the time you're above it, and you want to be very careful when you're below it. And I'll tell you that um, this is kind of how we started with the market school, how we came up with the concept. So many of the ideas is at the very beginning, Chuck and I just printed off a bunch of charts and kind of took that step back and just took highlighters out and took like a green highlighter and just said, okay, where is it trending up? It's trending up here. Where is it trending down? And then we put a pink highlighter. And then where is it chop? And we use some other color on there, and just to look at it with an open mind. And then we got Justin involved, and then we were testing out just all these different ideas. And Justin actually maxed out his Excel. And I didn't even know that was possible to max out Excel, but he maxed out Excel because we tested so many different things, and he just kept leaving them in there because we'd always go back and let's do a variation on something that we had tested before to see if it made a difference. And lots of things just didn't make a difference to the performance, but they sounded really good. Like we'd have really good ideas and we go, oh, what if we did this, and the other thing? And then we just look at reality and just go, oh, didn't really help anything, So every thing that you add on needs to help. Otherwise, it's just one more thing that could go wrong, one more thing that couldn't trigger, just like, the follow through day this week with the triple witching and stuff. Like every time you put another variable in there, that has to go in the right direction. So, as I've said before, as Edison, or no, it was Einstein's quote. I don't know why I go back and forth, but make things as simple as possible, just not any simpler. So that's a big part of how I like to look at things and how we approach this. So spend time just looking with an open mind. Just forget follow through days, forget 21 days, forget everything that you've learned, and just sit and stare at that. It's like what Bill would talk the fish bowl story. Just sit and stare at that fish bowl. So now let's kind of get into the historical examples, which I'm really excited to do. Let's see. So we're going to start off. So that this is the market, going back to 73, 74, and we're going to hold on. I got to move this over. All right. So we're going to start over here, and so this is 1971 when old Webby was born, and then here is 2000 over here, and we'll go forward. So we're going to take a select number of these and kind of walk through them. And this was just the research I was doing on my own anyways, this weekend. So again, I thought I'd just share it with you guys. So let's start with the first one. What do we have? 1973. Oh, wait, no, I don't want to do that one. Hold on one second. Okay, yeah, we're going to start in 78 here. We're going to start. Yeah, okay, so let's go to the daily. Let's go out to 1978 and 12:1. Okay, so here, this is, I didn't do all of them. Obviously, we don't have time to go through every follow through day, but I wanted to give you a sampling of how they happen. So we're in this, this giant bull market here, and then we collapse and we fall down underneath your 200 day. So even worse than what our current market is. And let's just blow this up a little bit to get a sense. So we're coming down, just crashing really from here to here. So we're on our follow through day. And I know that we don't, some of our historical stuff in market surge right now, we're having some data issues with NASDAQ Dow and the S&P, and I'm working with the data folks to try to get that cleaned up. We just have a data provider that just has some ideal info in there, and like we don't have volume in here on the chart on these, but I've gone through and all these follow throughs are going to be standard follow throughs, not follow through days in spirit, unless I say otherwise. So this was your follow through day, December 1st, in here, and so it closed up 1.31. Back then, we were only needing a percent gain, and it was on the late side. But one of the things we're going to focus on is where are you in relationship to your 200 day, as well as your 21 day. So the 200 day, the black line, is this your first real attempt at a follow through day or not? So let's just go out. Let's just go out to the end of the month. Speed this one up. So here was your, where was that? Okay, so here is your follow through day there. And you can see that on this day, let's see, on December 18th, you close below the low of the follow through day. So this is your exit signal. So this does not, this does not end well. And one of the things that I'll point out is, so this was your first signal to buy, your first follow through day that we had, official follow through day, not one in spirit. I mean, you could argue that like this was one in spirit over here. That's what I would have used because you didn't have, oh wait, no, you couldn't have used that because that was a fresh low. So that was day 1, 2, 3, 4. No, you couldn't have, that was only day 3. So you couldn't have used that. And yeah, either way, this would have been your first one. So, so I take that back. Yeah, this was your first day that could have qualified, regardless of in spirit or not. So then that becomes a low below, close below that becomes your exit signal. So you're here, it's trending up nicely, but you're stuck underneath this 200 day with your 50 day going down, which is a really bad situation to be in. And one thing that I'm going to point out on all of these is the extra conviction that you have of like, let's put us back on that day. Let's see. So here's your day. So you're starting to buy some there and you're using this as your exit. So then you go forward a day, kind of like what we have this week. It's not really material, but your low is above your 21 day. That's a good sign. Now your low is above your 21 day for 2 days. That's really good. Now your low is above it for 3 days and you close up. So this would be a signal to me to be increasing exposure, because now it's starting to trend. But in the back of my mind, I'm aware that we're coming up to this 200 day, which is a place where shorts will tend to pile on, and also this sharply declining 50 day, which was an idea that Charles had, that he was dead right about, that that's really hard to get through those without some chop. So then we go forward, just inching up, inching is trending above your 21 day. It looks really good, but you're getting close to your 50 day. Now your 50 day crosses below your 200 day, which is, I know people like that death cross and everything as a very, very late signal. We tested it out and it just didn't help. It became noise and kind of random. But I know people like it because it's a death cross and a golden cross and all that silly nonsense, but study it, man. They're just late. It's not that it's bad. It's just late, late and random. Cause I mean, look at this, like, is that really a signal when that day goes through there? No, it's a condition change that your 50 day is now underneath your 200 day, but a signal and a condition are two different, things. Like yeah, that's a big topic. So now it's coming down a little bit, but ups, looking fine. Now it's testing your 21 day. So, but it doesn't look abnormal. Like you just have to, we know that this gap's down, but your expectation is for a lower the next day because you're closing at your lows right at your 21 day. But it hasn't really given you anything yet to be concerned with until this day. Now that day you have to completely back away, and so that's the reality of follow through days. But it gives you a signal and something to trade against, meaning the low there. Now, in reality, if I was trading back then, what I would have done is I would have used that little mini upside reversal to start off buying. Even though it's not a follow through day, I do use upside reversals before a follow through day, buying some there, adding to some there because of the gap up in it following my expectations, as well as let's just go back there just for fun. So December 1st was our follow through day, but the day before that, and it kind of sounds familiar like what we just had, right? Upside reversal. Um, Even though it's not a really super powerful one, you at least can start buying there. This is off the reservation. Bill would not say to buy there. I'm just saying that I would buy there. And with now, I've got a very tight stop. And then if it goes up the next day, I can add to it. And so close above your 21 day, you get your normal follow through day. So that's kind of how that works. Let's just go out. I'm going to have to speed this up or we're going to be here all day. So we're going to go out in time. So that fails, but then it comes back. And so how I would look at this is one, looking for another follow through day, but also looking for the low to get above your 21 day and it to close up on the day, after three lows above it. So here's day 1, 2, and 3 days with it above it, and then on the 29th. So let's just go back to the 29th. So even though we don't have a new follow through day, at this point, I'm going to, me personally, not Bill, me personally, I'm going to start increasing exposure again because now it's starting to trend above it. And I'm very much aware that sometimes you'll get very, very late follow throughs. And in fact, let me just see what, if I have what the next real follow through would have been. What day was that? That was in 78. Oh, there, I just have to click a few things. So 1978, December. So January 3rd. Oh, that's why I'm not seeing it because it's not for. So there's your next follow through day was here. So and that was a genuine one. Volume was higher than normal. You're also up here next to that marked high, which is becomes important. But again, I would have been buying 1, 2, 3 like on this day and then adding there. That's just a style. Don't use my style. Study your own and come up with your own things. Let's just see. Go back to our next one. What was that? Okay, January 3rd. Similar. Let's see. God, I have so many. There's no way we can go over. Let's go to the next one. 1981. Going to go to October 2nd. Okay, so completely different type of follow through day here because we had this real capitulation type bottom on this day on September 28th. Let's go back there. So this is noteworthy. You'll hear a lot of people saying, especially on TV and stuff, that when you're in a bear market, you need this capitulation sell-off. The reality is major bear markets don't have a capitulation sell-off. They've warned people out. Shorter, and this is just my own observations that, this isn't a Bill thing. This is just me studying these, that when you look at the major market bottoms, like, back in 1932 or 73, 74 or 2000, 2003, 09, any of the really bad ones, you don't get a capitulation bottom because the whole thing was wearing people out. It just kind of stops going down, and then you get a follow through day. But in the shorter ones, shorter time frame ones, or the shorter depth, it could be maybe only 6 or 8% deep, um, and you'll get these capitulation. What capitulation is exactly like this day, the September 28th, where you have this big spread, kind of cleans out everyone's typically at a point where it feels exhaustive. Like if you know what a climax top looks like, if you were to flip this chart upside down, it looks like the opposite of a climax top, with a downside reversal, but this is an upside reversal. Well, we'll have to do something on climax tops. That's a good topic. But so you're coming down, coming down, coming down, and then you close up near the high. So this becomes your pink day rally. And notice how almost this entire time you stay underneath this 21 day. You're above it for a little bit here, but do we have 3 consecutive days up? Let me see. If you were only using that, not follow through days, you get 1 day up and then back under it. Let's see. Your low is above it here, lows above it there, lows above it there, but you're not closing up. So only 2 days. So if you just use that simple rule of mine, 3 days up, 3 consecutive lows above it and closing up, that would have kept you out of this whole mess from up here. But anyways, so here's your pink day rally day. Now let's go forward and let's go. So this is day 2, not day 1. Day 3. And now here's your follow through day. Wait, it's not your follow through day. That's your follow through day. Okay, so here's our follow through day. We're still underneath our 21 day. We're well off this bottom, and most people would be saying, well, I don't want to buy it there because I could have bought it 3-4 days ago. Well, yeah, you could have bought it there, but you also could have bought it here, and you could have bought it there, and you could have bought it here. Like you have really no, it would have just been luck, Now, in a major upside reversal there, I could see buying, frankly, because then your expectation, but you can't buy it in any big way because sometimes they're like that. And the next day, believe it or not, like it's much worse than you would think. But, I could see buying some there and then adding to it. But this would be outside, of the follow through day system. And that's not what we're talking about today. So here's our follow through day. Volume was higher than the prior day. You're up 1.81, which is more than enough. Let me just see if did I have any notes on this one? Okay, let's just go forward a little bit. Let's wait and see when our low is above the 21 day for 3 days in a row. So that's okay. So feels late. And so, one of the other things I'm going to test out is in a distance that your low is versus a 21 day as an or statement, but I'm not ready to release that yet. So right now we're just going to keep it simple by 3 days. So now you've got to be, kind of realistic. Like you've just gone straight up from here to here. And with that signal, you're going to temper that because the likelihood of, things even pulling back into here and still being normal is pretty high. And you've got this declining 50 day and you're a mile away from this 200 day that's in a decline. But still, you had a follow through day and now you're starting to trend above it. And let's just go forward another day. It's holding in there, just building on itself, man. That's normal. That's normal, like nice little upside reversal. This is looking good. Let's see. Let's just go out and then next month, see how that played out. Okay, so this is one that had kept working. So here was your first signal to get in. Here is your signal with the 21 day. Now you can think of that same concept with any moving average. I focus on it on the 21 day, but for moving averages, I like having that, the third day your low is above it and closing up as my signal that we're truly back above it. So over here, you've got day 1, 2, 3, but it's really not in the spirit of moving higher. I mean, it's technically a spreadsheet would have caught that, but it doesn't feel like it. I would really say this was your first real day with your low above the 21 day because this is your first like blue day. So day, I don't want to confuse people, but I just want to be honest. Day 1, 2, 3, but you're down that day. And then this day is your real day that, like, okay, you're starting to live above your 50 day. Let's just go forward a bit, see how this plays out. So you eventually fails, and you can see that once you close below your 21 day here for the first time, when you've been above it for a while on December 8th, that's when the character starts changing and you start rolling over. So again, our first signal was down over here, some more signals here, some more signals over here, and then over here we're getting our signal to get out of Dodge or start getting out of Dodge. Okay, let me go to our next date. I'm gonna have to speed some of these up. No, we don't want to do that one. Let's do March 18th. Okay, so March 18th of 1982. So here was what we were studying before. This is where we close back below the 21 day. 21 day becomes kind of a ceiling there. Now this is our next follow through day, March 18th of 82. And man, you're a mile away from your fall or your 21 day. Let's just go out a couple weeks. So now at this point, here is our signal. We stayed above it. That was our line in the sand. We get some power up there. And day 1, 2, this is your extra confirmation there. 3 days with your low above the 21 day and you're closing up. And let's go out a couple months. And so that was that signal. Here is your follow through day. And this is how you like it to work. And yes, my OCD is kicking in and all this bad data on this chart is driving me nutso, but it is what it is. So let's go out to your next one. We'll try to speed these up. August 20th. All right, so that one worked for, so here is our first low over there, that follow through day. Then we had another follow through day here, our signal there. And then look at this, you close back below your 21 day for the first time. And do you see why that works? Go back and watch it. Like that's why I came up with that. I mean, it is what it is. Like, works really darn well. Just have to say it. And then here, let's just go over here on this little thing on 7/27. Your 3 days. It does capture there 1, 2, 3, but like on this day there, that is a signal, but it's a mediocre one, but you still take it, even though it doesn't work. And then so you buy it there. So 1, 2, 3, you don't have a follow through day in there, but you do, or if we had one, I don't think it was one that worked. Yeah, can't go through everything, but if you buy using that, which I would have, then you're exiting it once it goes back below your 21 day. So you see there's like really no harm, no foul. It's like kind of like you're in Vegas and you're, playing blackjack and you get a push, like sometimes these are going to help, sometimes these are going to hurt, but in the end, it's like a push. You don't win or lose much. But if this kept going up, where do you have to have an entry? So let's see, August 20th. So we were just talking about over here, but now we get our real follow through day. Volume is higher than the prior day on August 20th. And what's nice is now your low is above your 21 day as well. Let's take a look. Let's step back from this a second. What we also notice, sometimes weekly helps, we've got 1 wave, 2 waves, 3 waves. Now, waves are objective, but sometimes they just jump out at you. When you get 3 waves down, you get even more aggressive when you go in and buy. Now, sometimes you can get 5 waves down, but 3 waves down is something we see a lot of. So this is our 3rd wave down, so kind of classic on a daily. Wave 1, wave 2, wave 3. Nice little follow through. Low is back above your 21 day, closing at your highs, and Let's just go forward a week. Okay. So on this day, let's blow this up a little bit. Is your low above it? Let's see. Your low is 165.07. And okay, so your low is above it for 1 day, 2 days, 3 days. So at this point, on the 24th, you get that added conviction that your low is above your 21 day for 3 consecutive days, and you close up on the day. See how different that is than this day here, the 723. Let's go back to it. That I said that yes, you would act on it, but you would reluctantly act on it. It's 3 days with your low above it, but it doesn't feel the same because it's not the same. It's not the same type of power that we had, over here. And now let's just go forward a few months. So we're in the Ronald Reagan days. This powerful move. Oh, this bad data is gonna, man, might lose my mind. But so 1, 2, 3. So here is our signal with our 21 day, and look, you're staying above it the whole time. Here's your first close on December 14th. Closes below your 21 days. So you're saying, you know what, I need to lock some stuff in because this could go a lot higher, but I need to be ready for maybe a trip down to the 50 day, which would be normal and natural. Gets close to it, doesn't get all the way in there. Then it starts trending back above it again. And let's go out. Let's go out a ways. Wow, that's a monster. Let's go out some more. Like, okay, that was really a monster. So that's from here. Like, here's our follow through day and that monster move, and almost the entire thing, with the exception of a few days here, a day here, you're above your 21 day. And then on this day, look at that, on 628. That's your first real decisive close below your 21 day sense over here. I guess I should have kept the 21 day as a secret, man, 20 years ago, 24 years ago, whenever it was. But works pretty darn well. Okay, so let's go out to 1984. We're going to go out to August. And I just want to say 5150 is greater than 1984. It's just a fact. Like a little over half of the folks got that joke. Okay, don't worry about it if you didn't get it. Some people, it bothers them if they don't get all my musical jokes, but it's okay. Just to keep me interested, really. Okay, so now we've got this long, drawn out time. So we closed below the 21 day. That's what we looked at there. Now we're back underneath this, and we've got wave after wave, like a million waves in here on the way down. And then we get a follow through day. What day is this? So this is 8-1. Yeah, just blow up my spreadsheet. My eyes are terrible. Let's look at a weekly and see how many waves we see. Sometimes it's easier on a weekly. So there's 1 wave. There's 2 waves. There's 3 waves. 4, 5, 6. Yeah, it's debatable whether you want to call that one, whether you want to call that a full wave or not. I would say this is the original way, like 6 waves in there. We've got to figure out how to program that in my spare time. So on August 1st, we get a big 1.59% return, close back above your 21 day. But why I wanted to do this was to just remind people it's okay for follow through days to fail. You're going to get follow through days in here and here and here and here and here, probably some in here that fail. And it's just like the 21 day, it pokes above it for a little bit and then comes back below. You have to use some sort of signal in there. Otherwise, what you could do, and there's nothing wrong with this, is just, if you're underneath the 200 day, just don't play. Just go to cash and wait. And sometimes it'll be a couple years, sometimes it'll be a couple days. But if you have that type of patience, you're better off. Like, with an algo, if you were programming an algo and it didn't have, FOMO and things like that in it, you would not trade underneath the 200 day unless you were doing mean reversion trades, which is a topic for, another day. But because when you're under it, bad things tend to happen. So, 200 days is a big deal. And with that said, like, if you're going for a follow through day underneath the 200 day and we're seeing all this type of damage that can happen, you can just have an artificially um, lower speed limit. So if normally you would say, okay, if it's working for a week or two, I'm going to, cap myself off at 50% in, when you're underneath the 200 day, there's nothing wrong with that. But just realize that there are going to be times where, like, back when we were looking at this one over here, you weren't above the 200 until over there. So there's nothing wrong with that. It's not a bad rule, frankly. I'm not sure what that right percent would be, but I would say, roughly speaking, probably, if you capped yourself at a max invested of 50%, on balance, that would be helpful. But it's really going to hurt you on that one last one that ends up working out, because you're going to say, oh, I could have made so much more, and it might throw you off. So sometimes a rule that makes sense in practice is going to hurt you more than it's going to help you. So here is our follow through day on August 1st. And let's just go out, end of the month. Okay, so at this point, day 1, 2, 3. Okay, on this day, your low has been above your on August 6th, your low has been above your 21 day for 3 consecutive days, and you close up on the day. But like I was saying before, that or statement of your number of ATRs past your 21 day and closing up probably would have gotten you there, because that was up 2.37, which was a big deal back then, on that day. But certainly on this day you would have been up enough. But let's go out a couple months, see how that played out. Ugh, bad data. It's hurting my soul. Wow, that was all she wrote. And then came up to your 200 day and just really ran into resistance. Let's go out to when's my next. December 18th was the next follow through day. So here was a follow through day in here, very powerful one, up 2%, 2.09%, clear follow through day, closes back above your 21 day. Let's go out a little ways. So we've got 1, 2, 3. So on this day, on the 22nd or the 24th, Christmas Eve, your low has been above your 21 day for, sorry, I just wanted to blow this up just enough. And you're back above your 50 day, and you're back above your 200 day. So you got a lot of signals that day to increase, but it is around the holidays, which makes it tricky. Now you're trending back up. Let's go out to the end of the month. Ooh, wow. Forgot about that move. That is a monster. And yeah, we've got bad data. So wow, that's just so powerful. And you would have been in for that, because there were no sell signals. Remember, just look at that 21 day. You're living above it that whole time. Let's go out another month. Finally, on this day, 3/7, that's your first real signal, right? You're in this powerful rally. That's why you don't give up. Like, look at this weekly chart. Like, look at this is on a weekly. All this chop in there, and that's why you want to keep it tight and keep it. Have your exit strategy, because then when it does work, you're there and you've saved your mental capital. Let's see what do we have next. Let's jump out to. Yeah, we'll just do all of them. We'll do all of them. We'll just go faster. Okay. So here's another time you're underneath the 21 day. This is on January 6, 1987, which, as I've said before, is actually a good year until it wasn't. You get a follow through day. It feels on the late side, but that is your follow through day. Your low has been above your first time your low is above your 21 day. Let's just go out a little bit. Let's go out to the end of the month. So let's see, 1, 2, 3. So this would be your day, your third day with your low above the 21 day and closing up. But again, like I was saying before, if you use an or statement, probably that day would have been enough, or certainly that day would have been enough. And now you're back above the 200 day. And let's just go out a ways. That was a powerful move. And look at that. All the way from there. And then you see why I like my 21 day more than anything else. I mean, that captures that whole freaking move, man. So find something better. Yeah. I'm totally open to it. DM me if you find something better than 21 day. Um, use it, man. Keep it a secret. Would not be cool. I'm sharing. Sharing is caring. All right, so let's go out to October 18th, which is our next one that we wanted to look at. October 18th of 1990. So again, let's point of reference. Here's our weekly chart. So, here is the 1987 crash. You recovered from there. Now you're living back underneath the 200 day in a big way in the 40 week. So we're down here, get our follow through day, still a mile away from your 21 day. Let's just go out a month and a half just to see how that played out. So it would have been tricky because you don't really get above your 21 day and stay above it until over here. And then let's see. Yeah, this was a tricky one, frankly. So what was our date originally? Did we say this is what, 1990, October 18th? So there was your follow through day. So the follow through day was ideal, really nice. But and you never close below the low of it. You come down and you do what Bill would call as like a back and fill. So that would have been really tricky. Frankly, just really put yourself in this shoes over here, like October 29th. I mean, come on. 21 day was your ceiling. It couldn't get above it. I mean, I don't even know if I've got any position left. I mean, we haven't undercut the low of the follow through day. So I'm not going to have much exposure because, I'm down from where I would have been starting to buy. But, the reality is it firms up there. And, I would have been leaning on the 21 day, frankly, with a 21 day and a decline like that. I'm not going to be getting crazy about things. Now we're closing back above it. And now it's more for real. Like I said, this is on this day here, the 14th. That's your first time your low is above your 21 day for 3 consecutive days. So I'd rather be getting more serious there, plus your lows above your 21 day. Let's just go out a couple months, see how this plays out. So it goes through here, and then there was enough distribution and other signals that we would have gotten back out of the market over here using market school rules, and Bill would have too. Like, back underneath your 50-day closing. Like, let's look and see how this looks on the 14th. I mean, that looks like a failure. So don't be intellectually dishonest. Know that it comes back up and say, "Oh, that's fine because I don't play that game." That looks terrible. It looks like it wants to go back down here. Frankly, does, because I mean that would be like saying on September 21st, this still looks fine because it's holding that low and all that stuff. And now that looks terrible. You're a mile underneath your 21 day, under your 50, underneath your everything. So that's why we don't do that. Let's see. Let's go out to January 23rd. I said this was really an important one. Okay, so this is your next follow through day. And this is a follow through day where I kind of refer to it as a follow up follow through day. So down here, this was your lowest follow through day during the cycle underneath your 200 day, but you got kicked back out of the market for whatever reason, heavy distribution and closing underneath your 21 and your 50 days. So you're looking for a new follow through day. We get one here, and this one ends up being a monster move. And so at this point, your low had already been above your 21 day for 1, 2, 3. So really on the 21st, so before your follow through day, that would have been my signal to start getting back heavy in the market, because even though you didn't have a technical follow through day, because let's just go through this. This is not, this is probably worth going through. So you're coming down, you're looking for a follow through day, looking for a follow through day, looking for one. That's day one, day two, day three. So it's day three is too early to be a follow through day, unless you're using a third day follow through day. Topic for another day. Sample size, just Cliff Notes, sample size is just too short to do anything in any logical way of the third day follow through day. Just a lot of hindsight and small. When you get a super small data set, it's really something I have to study on a bunch of foreign markets with clean data. But anyways, because with the Nasdaq, there's just only a handful of them. So now our low is above our 21 day for 3 days. We're back above this marked high, back above this marked high, both important things to me. So I'm starting to get heavy in the market, but we haven't had a follow through day. And then let's go another day, still no follow through day. And there's your follow through day. That's an official follow through day. So you're getting more aggressive. Let's go out a month. And that's a monster rally. I mean, a freaking monster. Look at that. I mean, oh my God. And look at that low versus the 21 day. That whole thing. So all the way up until the 29th. This whole thing captured by your 21 day. Pretty works. Okay, let's see what's next. We're going to go to our next one here, 1996. What? August 1st. All right, so this one kind of that capitulation bottom there comes down, doesn't undercut it, so we're still counting, and then here's our follow through day, closes back at your 21 day. Let's just go out a little ways, so you can see day 1 to third day where your low is above your 21 day, and your all is looking good there. Let's just go out a ways and see how that works. So that ended up working out well. This was a shakeout, but then by this time you had 3 days with your low back above it, so you're back in there. That you would have been backing away because of that, and then again, getting back involved there using that 21 day method. So that's 1996. Let's see. 429.97. And this is helpful to me too. I would be doing this anyways. So I just happen to be recording it. I just wouldn't be talking. I'd be going a lot faster, but it is what it is. So here's your follow through day 429, just right underneath that, the 200 day, your lows back above your 21 day. Let's see, what do we have for, there was no earlier follow through day. I looked in there, and let's see how this plays out. And that came, and this is why we did get involved this week with like Swing Trader and my own trading with that follow through day that was underneath the 200 day, because sometimes the very first follow through day underneath the 200 day does work. And here's one of those, one of those examples. And so you want to be, participating in that, because if that first follow through, ends up working, you don't want to, miss this. But again, your low 1, 2, 3. So on this day, that's your 3 days with your low above your 21 day and closing up. We still haven't closed back below your 21 day. So here's your first day, August 15th. So again, you capture a huge amount before you start backing away, and then things get more complicated. we'll go out to 1998. Oh, I love this one. 1998, 9/8. Okay. So here we get a crash through the 200 day. We get a follow through day. You're a mile away from your 21 day, and this one finds resistance here at your 200 day, and let's look at this. You get 1 day, 2 days, 3 days with your low above the 21 day. Let me see. Yeah, low above it and closing up. So that's your extra signal there. It doesn't end up working out. So again, if you're using the 3 days with your low above your 21 day, your exit signal with that is this day, your close back below your 21 day. And so like really no harm, no foul using that one. I mean, well, no, you would have gotten hurt there. Not materially, you were 1, 2, 3, 4 days. But then of course you had your earlier follow through day on the 8th, right there. So on this day, that's where you're buying, but immediately you close below it. So you buy there, you sell there. So frankly, the follow through day hurts you more than the 21 day, in my opinion there. And let's just how the data is. Now here's your next follow through day, and this is the one that Bill was buying AOL and Schwab. So here's what Schwab looks like, but really your true buy point, your upside reversal in your handle was on the 8th. So this is the day that you could have been buying Charles Schwab on October 8th, but look at where the NASDAQ was. That was just your upside reversal off the bottom. So I think it's still legitimate. You get a big spread closing near your highs, capitulation type bottom. And again, I'd said long bear markets and deep bear markets, you don't get these capitulations, but short and shallow ones you do. And so this was 33% deep from memory and very, very short. So it does lend itself to a capitulation bottom as a norm. So then I would be buying it there saying, okay, I'm going to buy it there with that day's low as my exit, just like I would have bought it on this day on September 1st, as an upside reversal with that as my low. Now, that's not part of the follow through day system at all. I'm just telling you what I would have done. So I do remember this time like it was like yesterday. I was in our research department, and boy, that was tricky. I did my first shorting ever in here, and I'm pretty sure it was Clorox that I shorted, CLX. And because I didn't know how to short, and I flipped everything upside down. I'm like, okay, well, I'm going to go for like low RS stocks or things that don't. I just didn't know what I was doing, and I called the market exactly right on one of these bad breaks, whether it was like this day here or this day, or one of the really bad ones. And I'm like, okay, I know what I'm doing. Figuring out this general market thing. I'm going to short an individual stock. I had no clue what I was doing. And then I was shorted. The market was down like a tremendous amount. It might have been like this day. It was a really bad day in the market. And I was short, and I lost money on my short, which told me, was my first time that I was like, you know what, I'm not going to short individual stocks, but instead I'm going to use inverse ETFs, which, it kind of came later with the Qs and the spiders, and then, either short ETFs or, using futures or something like that before there were ETFs. But anyways, so here's your follow through day. There was your day that Charles Schwab was actually buyable. And then here it's what it looks like on the follow through day itself. And now let's go out. Let's just go out to the end of the month. So let's see, 1, 2, 3. So on this day, 21st. So this is the day your low has been above your 21 day for 3 days or more, and and you close up on the day, and you close back above your 50 day. And so this is where I would have been getting heavy. And let's just see how that works out. Now you're back above your 200 day, and just a monster. God, what a crazy fun time that was. Let's see how far we go until we break the 21 day. So all the way until, well, that's just a minor one. Let's be intellectually honest and go out to 10 to 9. I mean, a computer would have gotten it over here because that was below it, but in spirit, it was that was questionable, but this is certainly your real break of your 21 days. So if over here was 3 days above it, and now if you're just using that, all right, I think we've established that. Okay, so let's go out to 2003. So what do we have? 227. So here was a follow through day. We're underneath the 200. So this is the bear market. I mean, you can't even see it on there. There was March of 2000, and wow, that was that was a terrible time. When I tell the story about my kids being born, I mean, they're born over here, so that was stressful time, man. Like that was really stressful. Like having twins, going down from 2 salaries down to 1 salary because I didn't want. I just personally, didn't believe in having. Some of my friends had like nannies and stuff for their kids. Well, one, I couldn't afford it, but two, even if I could, I wouldn't have done that because then you don't bond with your kids. In my opinion, I don't want to get off on. For me, kids didn't go to daycare, didn't go to, any of that stuff. The only people that watched them were family members because most precious things in the world, and that was so made lots of financial sacrifices to just have the one that one income in the middle of a bear market with a boss who didn't like to pay you much. But as I said back in my last one, during this time when I found out that I was going to have, I'll stop sharing because, when I found out I was going to be having twins, and Bill was the first, and I told this in my fear episode, that Bill was the first person who found out about that because I was sharing an office with him. Found out that I was going to be having twins and was stressed as can be. And it wasn't a surprise. I was going through the whole artificial thing because we wanted the kids and everything, and very expensive and all that stuff. But then just very nervous because I was commuting over 60 miles one way in traffic, and I was like, there's no way I'm going to be knowing how hard I work, how many hours I work, that I'm going to be spending a bunch of time on the freeway instead of spending time with the kids. So I knew I was going to have to move up to work, and I also knew that we were going to be going down to 1 salary, and still been thinking about this ever since I told you guys. Bill said during that, knowing how scared I was of everything, he offered for me to move in with them. Their maid's quarters. He just had some people move out or whatever, and so he had space for us at his house, and offered for us to just move in and live with him. And I didn't think my kid's mother would appreciate living with someone else, and so I didn't do that, and regret it ever since because, oh man, I don't, that would have been so wonderful. And I think the kids would have really dug Bill. I think I would have brought a different side out of him, frankly, but because he could be really, every once in a while, really funny and loose. But I mean, I'm talking every once in a while. Yeah. So I think that would have been cool. All right. So let's go back to that. Sorry. Again, you got to put up with these stories. I'm giving out a lot of free stuff. So yeah, be gentle. Okay. Let's see. Where were we? So yeah, that was at bear market, and oh wow, that was stressful. And then of course, a couple months before they were born, September 11th happened. And that was, oh man, that was spooky. Okay, maybe I'll talk about that another, because there is a trade involved with that worth talking about. I don't think I've talked about it yet, but here's your follow through day. So you get all these follow through days that fail, and then you get two waves down here. So this big bounce up off the bottom, two waves down. Bill was buying eBay around that time, and that's when he started building his position there. And you can see how strong that RS line was. And we'll go over eBay at some point. That was an important one. Let's go back to the NASDAQ. So two waves down. So we get a follow through day. Let's go out. Until your low never gets above your 21 day, even for a day, it doesn't look like. And then you close, what did I say, the 18th? So then close back below, it looks like over here, certainly by there. And so it's failed. Now we're going to be looking for our next follow through day, which was on the 17th. So again, this day is important, 312. So here's this terrible bear market. Well, here, let's go over here because this is that capitulation thing, 1010. Very important original research observation that I made, because you always hear people say you need capitulation at the bottom, blah, blah, blah. So this is a capitulation bottom. That one didn't end up working. Big spread closing at the highs. I mean, that's what a capitulation day looks like. This, 10.8, that's your low of one of the worst, not one of the worst bear market besides 1929 to 1932. And that's how it ends on a daily basis. Like, don't tell me you think that that's the bottom, because that's just crazy, right? And that's just how it ended up bottoming there. And then get back above your 21 day. And also let's go out to the to March. And so here was our bottom, big advance. It's like 1932. That's a topic for another day. And then one wave, two waves, three waves. And what I'll say is, a lot of times when you undercut the low of a prior low, like here, that turning and having that being your new low is very common, because just think about it. Everyone is sitting there saying, as long as it holds above those old lows, I'm going to stay in. And then when it does, they capitulate or they sell, and then they start going short, and people will get squeezed. And so it's very, very common to just have an undercut be your low, and that's an upside reversal. So the method I was talking about, you could nibble there, nothing serious, but using that low as your exit. And let's go out to the 17th. This is your follow through day. So unequivocal, huge up day, volumes higher than your prior day, back above your 200 day in a material way. Your low has been above your 21 day for 2 days, and you're closing up. Now let's see. Now your third day with your low above your 21 day and closing up. So that's your signal. And let's just go out a month. You had some backing and filling there. And then once you start going, you start trending. So you're chopping around your 21 day right there and right there. But now your low is back above it, 1, 2, 3 days there, and it starts working. There's some little shakeouts in there. Not as friendly of a market as some of the other ones we looked at, but in general, the bulk of it is above your 21 day, but you have little intermediate corrections in there that are trickier than you would actually think. They don't look that tricky now, but psychologically post the bubble crash had made it very, very difficult. Okay, let's see. Our next one is in 04. Wow, we're doing a lot today. Are you guys still awake? Are you still with me? Is anyone watching? Raise your hand if you're watching. I hope someone actually raised their hand. I would if I was watching. Okay, so now August 18th, 2004, classic follow through day. Underneath the 200 day, you can see you've got a wave down, a wave down, a wave down, closing back up there. Let's see if this one ends up working out. Let's just go out a month. It's a long time until your low gets above your 21 day. Looks like right around there. So then you get little chopped up there. So not really a great one, frankly. Ends up working out, but it doesn't really, like 3 days with your low above it there, and then you get chopped up. And then it's really, again, illustrates how difficult it is to make a lot of progress underneath your 200-day. Now, once in this position, 1, 2, 3, but this is your third up day with your low above your 21-day. This is where it really starts working. And again, and this is your first time it happens where you're above the 21-day. And let's just go out a little ways. So that was over here, and then you get this move, and then when you come crashing through your 21-day, then you go through a new correction. Let's just go out to with the rest of these. We'll go through quickly. 5-4, kind of as my good buddy Scott Sinclair, one of the nicest guys around, would say, rinse and repeat. Super smart guy. One of the best traders and humble dudes around. Let's see. So you've got 1, 2, 3, 4 days up in a row, closing up near your highs, kind of classic looking follow through day, but you are underneath your 21-day. But again, we've got 1 wave, 2 waves, 3 waves down. And again, it's not really until you get back 1, 2, 3. So third day with your low above your 21-day, close up on the day, and you get back above your 200-day. So that works pretty well. You get your corrective phase there, and then back above your 21-day there. So that's working out nicely. You get a little chop up there. Let's see. August of 06, August 15th. Okay, and I hope you guys spend a lot. I know I'm spending what seems like a lot of time on this, but really I'm speeding through this. There's so many other things that I'm seeing that I want to say, but I don't want this to be 5 hours long. So 3 waves down. So really study all of these. Now we get our follow through day. Wow, this kind of feels like it's on the late side. Our low is back above our 21-day. Let's go out to the end of the month. Okay, low is above it 1 day, 2 days, 3. Okay, so 3 days, but we're still underneath the 200 days, so you got to be careful, really careful. Let's see what ends up happening. And then up here, once your low is above your 200-day for 3 consecutive days, let's see where that is. 1, 2, 3. Okay, so yeah, over here, that's your first time where your low is above your 200-day for 3 consecutive days and closing up. But of course, we had it earlier with the 21-day, and it's really a nice move, and you don't get a real material break until this 27th. So, little closes around there, but not a material break. And you can see once that happens, on the 27th, that kind of a change in character tends to work out that way. So let's go out to our next one, which is the bottom of 09. So again, here's your bottom of your third worst bear market in all of time, and this is how you end. Just a random down day. Again, the whole capitulation BS that people say for major bears, just anyone who says that, I just know, like, hey, you haven't really studied stuff, have you? You just say what other people say. I mean, it cracks me up. Like, people just say what sounds good. Like, look at this freaking chart, man. Study a chart. Cracks me up. But things will say sell in May, go away. Study it. Study it. I frankly haven't studied that in a long time, so it might be true. But I've just lots of times people just, if it rhymes, people like the bigger the base, the longer in space is just ridiculous. Like, I study that, and it's actually the shorter the base, the better the performance. So like, the shorter the base, the better the performance. Doesn't rhyme. The longer the base, the further in space. But people keep saying it. People just don't do original research. So here's your follow through day on the 18th. And you had tons of follow through days in here that failed. So it'd be, and the world was literally coming to an end. Like I was scared to death. It was, so the kids were little at that point, and I have no problems with guns and everything. But let me see, stop sharing. Um, I have no problems at all with guns. I know some people do, and if that's your thing, man, this is not a political show. Whatever floats your boat. But I wanted guns, but I didn't want guns with little kids in the house because you just hear all the, you look at the stats and everything. And I was nicknamed the safety police because I was so overly protective of my twins because they were everything, are everything. And so didn't want a gun, but I almost did because I really thought the world was coming to a financial end, and so did Bill at the time. I mean, he had taken pretty much all of the assets out of the firm and split them up into T-bills in different places because we were just losing banks and firms like left and right, and so here he was very nervous that he had built this fortune up over his lifetime, and that even though we were like mostly in cash as a firm, we'd go in and get chopped up and stuff, but most of the time we were out, and so the cash was available, but he was really afraid that like any of our counterparties would go under, and then our money would be tied up at best, or we'd lose it, or not our money, his money, and so it was really, that is the scariest I've been felt, like more so than in the bubble, because I knew the bubble was just like 1929, and I thought worst case scenario we were going to have a repeat of the 30s, which we did. Um, uh, and But this was like, man, I was afraid of the banks not working, and really spooky time. So any of you guys who are newer to trading, like this was like the end of the world, man. It really was. And so that doesn't. With that said, screen and share. I almost forgot to share. That would have been okay. So this doesn't look like the end of the world, right? And then this doesn't look like things have really changed, but that is the reality of how bear markets work. So here's your follow through day. Let's go forward a couple days. So your low is above it, but it's not staying above it. Let's see. So 1, 2, 3. So here would be your first time 323. That's your first time your low is above your 21 day for 3 days, and you close up on the day, and now your low is back above your 50 day. So you're getting more serious in the market, but you're still a mile away from your 200 days. So you this is why it's so tricky being underneath the 200 day. But look at how that just worked. It was like a magnet to the 200 day and just trended nicely above that 21 day. Here's your first close back below it, which is like normal because you ran into resistance at your 200 day, close back below it. Your assumption is you're going to come back into the 1500. That's your base case, but it holds up better than you think. So that's giving you feedback. The market's stronger than you think. And it just kind of builds on itself. And what you should do is study this advance up with the advance in 03. And that was something that Chuck picked up on in real time, and later ended up sharing it with us about how he was using this precedent. And God, just kicked myself that I didn't see it because it was so obvious in hindsight. I was busy with pattern rec and other projects that I wasn't knee deep in studying historical precedents during that time because I was just really busy with other things. But he had that free time, and he figured out that this was just like the 0304 recovery, and traded this beautifully, and more power to him. I mean, just, and he's really, really good. I mean, he's really, really good. He's wired in so many ways that are different than I am, that just, yeah, just apples and oranges, man. But anyways, so you can see the bulk of this is spent above the 21 day, but this is just like kind of that June, July timeframe of 0304. Let's just go there. So here's 09. Let's just go out to 3 and see how similar that is. It almost looks like the same chart, and this looks like that same little thing, that little double bottom. Let's put a 9 there. history repeats itself. That's why we do this. This looks just like that, and just map that out. It's just uncanny. Okay, let's go out. I keep saying I'm going to speed up, and I don't. Let's go. We're going to just do the aftermath of these. This next few. Let's see, 9/1, 7/13. Oh, my dad's birthday. So here's follow through day, lows above your 21 day, 3 basic waves down, 1, 2, 3. Debatable if there's 4th, but really I see it as 3. Here's your 10, 13, and then right away you close back below it, and back. Let's go on the 16th, my mom's birthday, and see. So you have your follow through day on the 13th, and then you're above your 21 day. You don't get 3 days above it. You're running into resistance at your 50 day and your 200 day. Let's blow this up a little bit, and you close back below your 21 day. Close back below your follow through day. No harm, no foul. You get in a little bit. You get chopped up a bit, and this was the flash crash. I'll do a one on. That was the original flash crash, right? Yeah, I think so. There are like 2. Okay, what was their next date? That was July 3rd. Okay, September 1st. Okay, so now we get another follow through day, but this one is held up above the lows over there. But we clearly needed a follow through day at this point. You get your 4th day follow through, close back above your 21 day. Let's just go out to the end of the month. Let's see, 1, 2, 3. So right in there, your low has been above your 21 day for 3 days. Close up on the day, but you're still underneath the 21 day or under the 200 days. So you're waiting for that. Now your low is above 1, 2, 3. On this day, your low is above your 200 day for 3 days, and you close up on the day. So that's giving you that extra signal on the 20th of September. So really powerful there. And let's see how this plays out. So that was that day. Here was your, what did we say? Your follow through was on the 1st. So wow, that was a really good follow through day. Lows above your 21 day, lows above your 200 day, trending up nicely. And then on this day, you get your close back below your 21 day. So you're backing away. And let's go out to 11. August 11th, August 23rd of 11. So capitulation type bottom, but and I would have been buying there, but that next day, that would have been very difficult. I mean, down 4%, I would have just backed away because, and that's why you don't go too heavy on those capitulation bottoms. That in hindsight, people will be like, oh yeah, just load up. Well, then what do you do there? If you load up on that capitulation bottom, like August 9th, you had such a steep move down, and you have this, and it kind of reminds me of like in 2020, the COVID stuff, that sometimes it just needs time to settle down. So you're up 5% from the prior day. So you don't know your exit until it's down below there. So this next day that you're down 4%, like you're getting hurt. Like if the index is down 4%, any stock you bought is probably down 5, 6, 7, 8% more. Just food for thought there. And then when you get this gap down over there, you got to be really careful, because when you're in that position, you're underneath the 200 day and you get volatility like this is your market's way of saying that, like, there's no sign of equilibrium. There's no sign that, all is good. And you want tighter spreads, because that's telling you that bulls and bears are closer together. These spreads are all over the place. It's danger, danger, danger sign. Kind of like, nature has that way of, like, black widows have the little red thing, and like venomous snakes tend to have, lots of colors on there. This is like a warning. And it's the same thing. Like when you get these big spreads or big ATR, average true range, it's a warning sign that this is a very dangerous market. And let's just go through that. So that was your follow through day. But it's in a weird position, because here is your high since your low. This is your day one rally day. And you're a million miles from there. So yeah, it's a follow through day, but I'm not going to take it too seriously, frankly. Let's go out a week. Now I'm going to take this more seriously because now your low is above. Um, let's see. Oh, it didn't go. Oh, that's funny. It didn't even stay above it for 3 days. 1, 2, 3. But you're not up on the day, so my signal would have wouldn't have triggered there. So let's just go out a little ways and look how choppy that is. It's all over the place. So when it's all over the place, it's telling you are in a dangerous market. Very, like unless you're a super nimble like day trader or something, you're going to get chopped up in something like this. Let's go out to the next follow through. So out on the 18th. So it's all over the place. We get another follow through day. You're well off your low. So again, a capitulation bottom. You could have bought some there, like you would have bought some here. But the difference here is the next day you had good action, so you could have built on that versus the next day here was terrible. So you could have bought some here, could have bought some added to it there, but not gotten carried away because we're in this danger zone. And call it the Webby danger zone. And so here our low 1, 2, 3. So our low is above your 21 day for 3 days, and you close up, but it closes well off the high. So I'm not going to get too serious there. But the next day, that day there, just being intellectually honest, 10/13, Sammy's birthday, Sammy Hagar's birthday, that you would have that would have triggered it and said, okay, now I'm going to start getting deeper in, even though we don't have a follow through day. But on the 18th, you get your follow through day, nice action, upside reversal. So then the low of the follow through day becomes even more important than normal. And it holds. Now you're back above your 200 day. Let's go out a month. And you see how choppy it is. And that's what I was saying with these, when it's this violent in here, you still play, you just really temper your enthusiasm. Meaning you're going to trade tighter stocks, lower ATR stocks, not go in as deep. Maybe instead of buying a TQQ, you buy the QQQ, things like that to just dial it back. Let's see, 12/20 is our next date. I hope this is helpful for you guys. It's helpful for me to review these. I review these so many times, but every time I learn something. I learn something every time. Every single time. I'm learning a lot this time, even though I've stared at these and stared at these. And what I'm learning is really to temper myself when I'm underneath the 200 day, like reinforcing, looking at these is just saying, you know what? Yes, you can have these big moves like here, but those are few and far between because most of them are more like chop like this. So here it's tightening up a little bit. You can see the spreads are starting to get a little bit tighter, but it's still wild action. We get another follow through day, up 3%. Let's just see. It doesn't really have a lot of follow on afterwards. Let's go out another month. It's not really until, let's see, your lows above there, 1, 2, 3. So on this day, your lows above your 21 day for 3 days and closes up, and you're back above your 200 day. So that's the best it's looked at that point. So on January 5th, that's the best it's looked, but it's still, we're in the middle of this, very crazy time frame. So you want to temper your enthusiasm here. Let's go out to the end of the month or go to another birthday. Very important one. Okay, so you've been trending up there, a little downside reversal. Let's go out to the end of March. So you've been trending up nicely. The only time you had on 3/6, you get this shakeout. So you would have backed away there. I would have backed away there because I would have been expecting a trip down to the 50 day. But right away, back above it. Let's go out a week. So at this point, let's see, 1, 2, 3. On this day here, your low is back above your 21 day for 3 days, and you close up on the day. So and you would really, your low is back above it here. At that point, you could have gotten more serious about the market, increasing your exposure and certainly increasing it more there. Let's see. Let's just go out a ways. So then your next time it did it, like 4.9. So this is why you do act on those, because this one actually looks better than this one that was just a shakeout. And I know what you were thinking there. Oh, that's just a little shakeout. But look what ends up happening, just a week later from there. All that devastation in the 21 days rolling over at that point. So that real first break of your 21 day, you do want to take seriously and take action, especially if you've been above it for a long period of time. So our next one here is 2015. And what's the date on there? September 8th. September 8th. Okay, another wild, crazy time in the market. And so with this one, you've got to really temper yourself, because this is up 2.73%, and it doesn't look like anything on the chart, and you're back underneath your 21 days. So you want to be very careful. Let's go out to the end of that month. So there was your follow through day. Your low never got above it for 3 days, above the 21 day for 3 days. Just 2 days right there. And then that would have kind of saved you from going in much deeper. And of course, you have the 200 day there as an issue. Let's go out to the 15th of October. So now you have another follow through day. Much nicer, because your low has been above 1, 2, 3, 4. Fifth day, your low is above your 21 day, and you're closing up. So I'm going to take that more seriously. Plus, you get a follow through day, and you're back above your 50 day. Let's go out to the end of the month. And that traded nicely. And you see 1, 2, 3 on this day, your third day with your low above your 200 day and closing up. So you can see that the characters, kind of changed there. Let's see how this played out though. That was volatile times. So you're up there, then it comes right back down on here. You're back below your 21 day. You get chopped around, then you fall out of bed again. Like, this was a terrible time. I mean, crashing below your 20, your 50 and your 200 day, like it's nothing, just going straight down. So again, really dangerous times. Let's go out to July 8th. Really dangerous market environment. So this is that time frame, but you can see that this is much tighter than over here. So this area over here is much tighter. The spreads are tighter, but still very dangerous time around the 200 day. And the way I look at it is, I think a lot of algos have found out how important the 200 day is, and they just have rules that said, okay, when you're above the 200 day, buy, and when you're below it, sell. And that has a kind of a ripple effect on things, and make things much worse. So here's on July 8th. You've got the nice follow through, and let's play this out. So, and well, this was your Brexit vote. I mean, that's a whole topic in itself, and a new, around news and everything. But so this was like really an expectation breaker here and here, because you went home that night, from memory. I think we went home thinking Brexit was going to go one way, and then there was like, God, it's been so long. I'm probably remembering this wrong. Anyone who's in Europe will know this and just be like, "Oh, you're wrong about that." But I think the weather was bad, and then so the voting was different, and I don't know. I shouldn't be talking about things I can't remember for sure. But I remember going out to dinner that night and just thinking, "Wow, we're going to be coming back down over here," just with the news and how it felt. But within a couple days, it firmed right up, and then you had this character change, these 3 big up days in a row. Now, not a follow through day, because this is your third day. And what do we have in here? 6/30, 2016. Oh, where was the follow through day? So you would have had what, a follow through day? It's not on my spreadsheet. There on July 8th. Oh, yeah. July 8th of 16. So let's just go back there. It is on my spreadsheet. I was just looking wrong. So here is your follow through day that we were looking at a second ago. It looks really convincing. And you can kind of see this as a double bottom now, right? nice little double bottom. So sometimes you get those patterns in the market. Not a perfect one because the middle normally doesn't go above your left side high, but still double bottom in spirit. And that was your follow through day. Low 1, 2, 3. So here's 3 days with your low back above your 21 day, and you're kind of off to the races there. And really nice trending. And then, of course, you get your close back below your. This is around the elections and stuff, so it got a little funky. But we'll just go out a ways, and you can see how I think this was prior to the election. That's a whole topic in itself. I won't do that because I just don't want anything to remotely get political, because I know half the people think one way, or like 48% of the folks think blue, 48% think red, and you got some in between. And, you know, yeah, I don't want to piss anybody off. I'm here to help people, not play politics. So if everyone once in a while a little political thing comes out, it's not my intention. It's just either relevant to the chart or it slips out by accident. But it's never my intent, because I don't want to. I don't like when people talk politics that, like, especially musicians and actors and stuff that I like. And it's like, dude, I don't want to hear your politics. Like, you're not a politician. I'm not a politician. Like, like, shut up, man. Do your thing. So, Mike, just shut up and do follow through days. That's fine with me. Okay, 11 September. But if I could live over again, I would have been a congressman or a senator. I would have, or at least tried. But too old for that. So, okay, 11/7. So now you get another follow through day, just really kind of similar to our current market where, oh, no wonder. This is my base case that I've been using. Like, we're already to my favorite one. This is the one I've been using for a long time that I think is like our market. And really, this was, I don't want to get into it, but Powell, Fed Chairman Powell just messed things up, around over here. This must have been the when they go out to not Yellowstone. Help me out. You're yelling at your computer right now. When they go out and they hang out in. Oh my God, I'm drawing a blank. But anyways, I'll think of it in a little bit. But all the folks, they get together, they hang out in Wyoming or wherever it is, and they Jackson, and then he'll give big speeches out there, and it can really impact the market. And he was playing chicken with things, and it didn't really change until January 4th. But that's a topic for another day. Let's just focus on the follow through days. So here we've got our first follow through day, closes back above your 200 day, but here is our first follow through day. And so you give it a shot. It's very convincing. Your low is essentially at the 21 day, material gain up 2.64. It has been volatile, but this is a classic looking follow through day. Let's see what happens the next day. Inside day, doing nothing wrong. Now, this is your signal to exit. So no harm, no foul. You bought on your follow through day, and you close back below the low of your follow through day, just like what happened this week that we talked about at the very beginning. And there is your exit to get back out, and you've closed back underneath your 200 day. So let's go out to your next one. So your next one actually isn't until official follow through day, isn't until here. This is your next one that a computer would have picked up on. But I would have said that there was a follow through day in spirit over here. Let's see, like 1, 2, 3. Like that feels. Why isn't that in my spreadsheet? 11/28. Because that should have. Oh, it is in my spreadsheet. Yeah. So that is a follow through day. Because that looks like one. So there's your follow through day. Let's see. You don't get your low above your 21 day for 3 days. You come crashing back below your 21 day. So that would have been enough for me. Running into resistance at your 50 day, closing back below your 21 day in that material of a way. Like let's just look at this day, 12/4. That would have told me that, the back way. You don't have officially your you're above it here still. Um, and but that was that rule that we came up with. Oh, I think I was going to tell the story of that, and I got sidetracked. Yeah, I'll tell it now. Let's just go out a week. Um, if I did tell it, then man, I need to get some more sleep. I think I. Oh yeah, I did a little bit, but I'm not sure if I explained it exactly the way I wanted. So originally, yeah, I did say it, but originally Bill had it as you didn't know that your rally or that your follow through day, so this day here, had failed until you got there, and we just knew that that was a mile away, and so then we did the original research and came up with the undercut of the follow through day or close below the low of the follow through day as your exit signal. And then we kind of had to address that with Bill, because we were coming up with these rules, and then we just kind of asked him. We're like, okay, well, we would want to know what he thought because we had these rules, but we hadn't run them by him yet, but we knew that they worked. And so we addressed it with him, and he was like, well, no, you would want to be out long before you get that low, and look at this and this, all these things. And it was like all the things that we had, for the most part, that we had picked out, that we could, anything that could be put in a spreadsheet, we had pretty much had, of the things that he was saying, is because you would want to know that we either had it directly or indirectly getting at the points that he was making. So that was good confirmation, and that was a big improvement because, originally, like I said, the follow through days, you get a follow through day there, and officially you don't know that you're out until there. And that, man, that's you're getting chopped up to pieces if you do that. So buying there and selling there, or worst case scenario, like this is a worse example of selling there on 12.7. That's when you get your first close below there, and as official, a spreadsheet would pick up that is a sell signal, but really there's where you're out. Then on January 4th, I would call this a follow through day in spirit. I remember it like it was yesterday, and Powell had switched course. It was a game of chicken. He finally capitulated, and then he had you could probably find this on YouTube, and I'm pretty sure it was January 4th. From memory, it was January 4th that he sat there with Bernanke and Yellen, and then read off the sheet. How he was switching gears. It was kind of like he brought his big brother and big sister, so he could get some credibility, and then you know that turned the market. If you haven't picked up on it, I'm not the biggest fan of Powell, not as a person. I think he's a fine person, but just as a Fed chairman, um, just not impressed. But anyways, the here would have been your follow through day in spirit. Now keep in mind this volume is less than the prior day, and why I just say that's just dirty, dirty volume there. Now you did get a follow through day on the S&P that day, but what if you hadn't? Because volume was higher on the New York Stock Exchange, which is what we use for the S&P, which doesn't really make sense, but that's a topic for another day. Should really use the volume for the S&P stocks or a combo of Nasdaq and New York, because the S&P 500 is not just New York stocks, but historically that's what Bill would use for the Dow, and then for the S&P he would use New York volume. I mean, that's just silly. It's just totally silly, but it was just how we always did it. Because if you're looking at an instrument, a price instrument, which is the S&P, which is dominated by Nasdaq stocks on a market cap basis, but you're using the New York Stock Exchange consolidated volume for that signal, and I'm surprised not one person has ever said that to me. Not one person has ever asked me, like, why do you do that? Not that I remember. It's silly, but you know, if I was going to use volume, I would use a consolidated dollar volume. I would use all the volume in the market on a dollar basis, not a share basis, so you don't get the influence of your $1 stock that has some news as trades hundreds of millions of shares that day, that distorts the consolidated. Consolidated just means you add up all the volume on the in the stock market. So a consolidated combined would be both NASDAQ volume and New York, and then and just look at that, but from a dollar standpoint. But anyways, so here was the follow through day in spirit, and then your true follow through day would have been on the 15th. So if you're waiting for volume, all those folks this week who were like, clapping it up because they didn't call the follow through day on Monday and saying volume wasn't there, well, those same folks would be using this one over there, or answering the question of, why you're using New York volume for half NASDAQ instrument. So now you're back above the 50-day, closing back above there. You get your real follow through day. Your low has been above your 21-day, 1, 2, 3 on this day here, but you're still underneath the 200 days, so you've got to be mellow about things. But it looks like it's a magnet for the 200-day, and sure enough, we're going out, and that's what ends up happening. And here was your first break of your 21 days. So right there. So you follow through day in spirit up to that. It's pretty darn good. Closing back below your 200 day. But then you get back above it 3 days with your low back above. 3 days back above. And is kind of a signal that was just a mistake in the market. We're almost done, kids. Let's see, what's the next one? 2020. And these ones you guys probably all remember already. 4-6. That's the Tom Petty don't back down follow through, I think. So another crazy one. This is your COVID time is wild. And I think we talked about this on a different one. So here's your follow through day. Let's just go out to the end of the month. And your low 1, 2, 3. So your low is above your 21 day for 3 days. You can close up on that day. You get that signal. I really thought that we were going to stop here and come back down, but I was wrong. And let's just go out. I really thought this was going to be like 1998, which it was looking like on this day here on 421. Looked like it was going to come back down. Like that would have been totally normal and natural to come back down here and be just like 1998. If you've forgotten 1998, let's just go back there. So here was that 1998 up, double bottom. Like that's what I was expecting. So I was thinking we were like September 30th or so. Let's see, like around there. Like, come on, just, it looks similar. So let's go back to what were we, 4/6/2020. COVID, man, those was some crazy times. And then let's see, couldn't even walk on the beach. What in the world? We lived down 3 blocks from the beach at the time, and they had blocked off the street. You couldn't even park along the street along by the beach side. Wouldn't fresh air be good for people? Like, cops out there with guns and stuff, like big guns, if someone was out there. Oh, this world. Okay. So 413. Let's see. 1, 2, 1, 2, 3. Okay, so there. And then let's just go out here. When do we get our first real break of the 21 day? Kind of a baby break there, not real breaks. Like you have to take some action, but that's a real break. That's September 4th. That's your real break during that whole run. But that was actually trickier than you would think. Okay, what's next on our list? What do we have? That's 2020. Okay, 2022. Almost done. I always wanted to have a I'll go back and listen to this just so I can see the charts of things and study it that way. January 31st. I really got to thank Justin for putting this spreadsheet together, because it would take me a gazillion years to do this without his work. Such a great guy. Yeah, I call him the saint because he's a perfect dude. He really is a good role model and a great father. Um, let's see. So on, God, this date keeps on jumping. Okay, the 24th. So here's a capitulation bottom. And again, this is something that, that with a big spread like that, closing at your highs, the market's making a stand, and I would buy some, on that day with the assumption that we were going to go back up. It would be a little, that would be spooky. And let's go out to the 31st. Here's your follow through day. Um, and that next day would have freaked me out, like this day here, like coming back down, I would have backed out of anything about there. You want to look at a chart and know what you would have done. You don't want to look at a chart and say, yeah, I would have bought it at the lows there because some BS stuff, and I would have top ticked it here. I hear so many people say that, and they say it with a straight face because they believe it. They honestly believe what they're saying. I don't think they're lying. They're just. I think very few people are lying. I think that they've fooled themselves into thinking, and so in the real battlefield, they're not going to know what to do. Frankly, so you want to look at any chart and go, okay, I would have bought it here and I would have sold it here. Like if you can't do that, get there. That will be our goal for a series is to know exactly where you would have bought a stock or sold a stock, and same thing from a market. Doesn't mean you're going to be right, but you just want to at least have to know exactly what you would have done, and then you can learn from there and go, okay, well, I would have done it there, but I would have been wrong. Was that a bad trade or just bad luck? That whole thing. So you get a follow through day here on the 31st, and that was after your first breakdown below your 200 day, and then that one ends up failing. And then let's go out to your next one, 318. And notice on that one, you never get your low above your 21 day for 3 days. So you don't getting super serious about the market. Then on 318, you get another follow through day. This one's a little bit more interesting because you're back at your 50 day. Let's see how that one pans out. Now your low is above your 21 day, 1, 2, 3. So 3 days. So you're getting more aggressive in the market there. And again, you had a capitulation bottom that you could have traded for a few days and then had to back out of it. But now it's looking good, but you're going up against your 200 day, which is a hard one to deal with. And to see, you run into resistance at your 200. Okay, and then let's see what's next. Which one was that we were doing? We were doing March 18th, 5/17. Okay, so another follow through day, fourth day follow through. Looks pretty cookie cutter. Let's go out. So there was our follow through day, and right away that very next day you close below it. So you buy there, you sell there. That's just reality. Let's go there. So follow through day fails, and that's why you don't get too heavy on most follow through days, because that is and that's down 5%. You get really chopped up there. 517, let's see, 526. So now you get another follow through day. Let's see how this one pans out. Got a month. So 526, there we were there. Your low never gets above your 21 day for 3 days. During this time frame, this whole time frame, you're basically staying under your 21 day, a little blip above it, but no 3 days above it. I mean, that's pretty powerful stuff. So we get another follow through day on the 24th, then we close below it here, so 628. So you buy, you sell, down 3%. You're going to get chopped up. So when you're underneath the 200 day, again, you want to temper your enthusiasm, and that's another reason why we're doing this, because we're going to get more follow through days, and you don't know how long this market is going to last like this, and it could last like any of these that we're looking at, and you want to be careful because you're protecting your mental capital as much as your real capital, your dollar capital, because when the market finally does turn, you want to be confident in your signal. 620. Okay, 624 and then 628 fails. Let's go out to 1021. This is a little too long, even for me. Sorry, guys. So back above your 21 day there, or close above your 21 day. Let's see how this works out. You're messing around with your 21 day there, and it doesn't. What was the date that I said? The 21st. So here is your follow through day right there, but it never really, it doesn't trend above your 21 day. It doesn't, it closes back underneath it, just really nothing special there, just really a lot of chop. I mean, this is what my good friend, I haven't seen him in a while, Arusha, would call the chop zone. And I call him Mr. Smiles. What a nice guy. I mean, I've never heard him say anything bad about anybody. He's just one of those people, just if he doesn't have anything good to say, he just doesn't say it. And I should be more like that. I'm not exactly like that. I kind of say it the way it is way too often. Okay, so January 6th. Let's go there. So here you get this follow through days is in this weird position. It just doesn't look that strong, 2.56%, but it just doesn't feel strong. It's underneath that the 200 day. Let's see, let's go out a month. So let's see, 1, 2, 3. Your low starts trending above your 21 days. So at this point, I would start being more serious about the market because your low is above your 21 day for 3 days, and you're back above your 50 day. And let's go out further. So it holds, but just not easy. Like that was a terrible environment. I was getting chopped up in that. That wasn't fun. Let's go out. Sorry. Go out to the 29th. Okay. So we finally get above our 21, 200 and our 50. Other thing to keep in mind is when you get the 50 days or your moving averages in the right order, meaning your short term is above your medium term, your short term is your 21 day, your medium term is your 50 day, and your 200 days, your long term. When you get them in the right order, meaning over here, your 50 is above your 200 and your 21 is above your 50. So that's in the right order. And your low is staying above them, which it was over in this area, not in a real big material way, but let's see, right there on March 31st, that's where you can see that it's different. Your low is above your wait, I didn't do the right date. March 31st. Your 21 green is above your red's above your black, your low is above the lows of all of them for 3 days, and you close up, and that's the position. That's where you get more serious about the market. So now let's go out. Almost done. We've got 3 more left, kids, and grandkids if you're watching. And yes, your grandfather used to always babble on this much no matter what the topic was. Sorry. Hopefully you didn't inherit that. So here we've got a follow through day. Looks good. Back above your 50 day. All looks good. Lows above your 21 day. Wait, no, not 3 days. That's 2 days. Let's just go out a week. Oh, you never trigger that because 1, 2, but all these are red. So you never got your 3 days above it. Let's go out a little ways. So it didn't end up working out, so you didn't get that extra conviction there. So this was one wave. Now we're in a second wave. Let's look at October 6th. Okay, so we get another follow through day. So first wave, second wave in the back of our mind. We're like, oh, there might be a third wave, but you got to be objective and keep an open mind. Get back above your 21 day, but your low can't get above it for 3 days and close up. And you run into trouble at your 50 days. So that's problematic. Now let's go out the rest of the month. Now we have another wave down. And let's go to the first. So 1 wave, 2 waves, 3 waves. They don't always come in the same. This one is very cookie cutter. Like remember watching this going, oh my God, 3 wave. Like I was thinking kind of like what people were saying recently about some stocks that were like too obvious that of course they're going to fail. Is I was saying the same thing about this one to myself. I was just like, oh man, like this is so obvious and so cookie cutter that maybe it doesn't work with the three um, with the 3 waves and everything and getting support around your 200 day. Now let's just go out to the end of the month. So we had our follow through day there. Your lows above your 21 day for 3 days and trending up there. Take out that marked high there. I mean, and I remember listening to a bunch of people, and they were so um, they've since done some revisionist history, but they were so negative there. I was like, oh, they're going to wait for a pullback, and it just drives me crazy, man. Because like, study some markets. This is how they work. Like, look at that move. Like, once you get the follow through and you get trending above your 21 day and you're back above your 50 day, like this is normal. But people are like, I'm going to wait for a pullback, and then when you get a pullback, no one wants the pullback. So don't be that guy. Um, and so, but here on the January 3rd, that's your first close back below your 21 days. So now you're getting nervous and that it might, when this happens, I always think you can travel into your 50. It doesn't always happen, but that's what you want to think of. And it didn't happen, and it just went, you know, ended up going higher. And so um, again, like here was our, let's go back to a current reset to today. Here's your NASDAQ on a monthly chart. Focus in on these and go and study any of the time we're underneath your 9 month or your 40 week or your 200 day, and study those follow through days and study the time under there, because when they're under there and living under there, it can get really ugly, and a lot uglier than you think. So let's see. Stop sharing. So man, that was freaking long, almost 3 hours long. So I can't make them that long. No one's going to listen to them, and I'm sick of listening to myself. So we're going to make this last part a little fast. Switching gears. If you're done, man, thanks for hanging in there. I'm going to talk about my stock stuff or my music stuff, because that's what I like doing. And so I thought, I'm going to run out of people that I like, because there's not a whole lot of people that I like in the music industry or bands and stuff. And so I was going to start focusing in on albums. And so one of my favorite albums of all times was Guns N' Roses' Appetite, which is this shirt. And I'll tell you, this album is one of the best albums of all time, and little story that when I did my first, this is not the original Guns N' Roses CD that I had. My original one I had to sell. When some people, or as a friend of mine would say, are born on third base, and they think they're a genius, and some people are born on the way to the baseball game. And so I didn't have money to start trading, unlike some people I know who've got inheritance of tens of thousands of dollars and think it was a little bit. And I didn't even have 400. I was trying to raise $700 for my first trade. And I'll do a whole thing on this, but it took me 6 months to save up $450, and of which one of the things I had to do was sell the only thing that I had of value, which was my CD collection. And I sold all my CDs that I could, that they would buy, to try to raise money for my first trade. And so you can start super small, and Bill did put that in his book, and he had to specify that it was when I sold my CD collection, it wasn't my, my stocks that my aunt gave me or whatever, or my uncle or grandfather or whatever that some folks get. It was sold the only thing I had, because I was dirt broke, man. I was in debt, out of school, not making much money. I was making like $22,500 a year, and commuting 60 miles. I mean, it was tough and really tough. And so I had to sell everything I had, and cashed in a bank account that I'd had since I was a kid, and literally went through my piggy bank. It was actually a rabbit. I had these $2 bills that my grandmother had given me. Well, I guess I'm telling the whole story, and I had to sell my CDs, and then eventually, bought them back and stuff. And at the time, I didn't know that there wasn't Napster, there wasn't Spotify, there wasn't, that was it. That was my identity, was my music, and had to sell it. So, I don't want to hear like someone, oh, it's too hard, whatever. Like, commissions were $28 a ticket plus a nickel a share, and so, anyways, and I also brought out this this was pre YouTube. I paid like $70 for this. This is Johnny Lang. Just some guy had recorded this concert, and it was Johnny Lang did this acoustic set at the House of Blues, and I want to say it was in Anaheim. And oh my God, it was, at the time, it was my favorite concert I'd ever gone to, and it was just like, he was normally this heavy electric blues guy, and he did this tour where it was just acoustic, kind of, I think, like Eric Clapton unplugged, and it was just so good. And there was nothing available, and I bought that off eBay for whatever, $70. I don't remember, something like that. So now all this stuff is out there for free. So just put yourself in that mindset where you can't get stuff, and you have to sell. So anyways, the story about Guns N' Roses, this album, this is one of the few albums that is, like, I call it a 10 out of 10. Like, there's no bad songs on there, and I'll go over other ones in the future that are like that, where everything is really good. But before I heard them, I was very closed off with my music, because growing up I was only into old stuff, like the oldies, Chuck Berry and obviously Elvis. Elvis was my, Elvis was and is up here for me. Buddy Holly, big Buddy Holly fan. So that, and I would venture out to, like, the Beach Boys and things like that. But it was a very old school music. And then eventually I heard Hendrix when I was in the seventh grade, and that changed everything. And then I switched from the oldies from the post Elvis stuff into listening to anything in the 60s and 70s, and really thought anything past 70s was terrible. So, like, Van Halen was like the newest stuff that I would listen to, but everything else was like Zeppelin and Hendrix, and all the earlier types of things. And so I'm at this swim meet in 1987. I'll never forget, because some people will never forget where they were when, like, Kennedy was shot, or when the first moon landing, or the or anything, various important things in life. And I remember the first time I heard Guns N' Roses, sitting in a tent, waiting for my event at a swim meet, and this girl that I had this huge crush on, who was into Duran Duran and stuff like that, and knew that I was very closed off with my music. It was like, my music is the best and your music sucks. And that's how I've been my whole life. And she's like, no, you really want to listen to this. This is really good. This album just came out. So this was 1987 when it came out. This was late summer that I was there. I'm like, no, I didn't want to listen to it. But because I had this crush on her, she was cute, I put on the headset, and already thinking, like, how long do I have to listen to this before I tell her I don't like it and still have a chance with her? We never got together, but I don't think I was cool enough. But she was out of my league. But that's okay. So anyway, so I put this on, and I hear it, and I hear Mr. Brownstone, and that was the perfect song, because that was like Bo Diddley. Bo Diddley was from that, the Chubby Checkers and the Chuck Berry and the Elvis, and Little Richard and all that stuff. Like, that was my wheelhouse. And I'm like, this is Bo Diddley. These people like Bo Diddley. And in 15 seconds, I was hooked. Instant lifelong Guns N' Roses fan. Saw them a few times. I saw them once with Metallica. I think that must have been at the Coliseum or Dodger Stadium. But then when they broke up and Slash went his own way, so I'm a Slash fan. Like, so you're either like a Slash fan or an Axl fan, and I'm a Slash fan, and so much so that when Axl went and did his Chinese Democracy CD that took him forever, or album, whatever you want to call it. I've yet to listen to it. I refuse because he didn't let Slash in. So I'm just, I'm loyal, man. If I like something or someone, and I'm a huge, 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 huge Slash fan, and he, I think, has a great work ethic, because if you hear anyone who talks about him, he's very much like Bill, and who I try to be like, is just like a workaholic, man. Like he's always playing, always has his guitar with him. And so anyways, so this is like the perfect album. And what I would say is, I'll just share, let's see, something I thought would be cool for you guys. Like if with just going on Spotify, that if you go to the album, so Appetite for Destruction is, the album I'm talking about here is Mr. Brownstone. They're all great songs. What's the best song on this album? No. Try again. No. It's Rocket Queen. Everyone knows it's Rocket Queen. Well, it's my favorite one. But what you can do also is the Live Error 87, 93. This has a lot of those songs, plus some that they did on the Lies one, like Used to Love Her and Patience and stuff like that. Mama Can, which is a great Aerosmith tune. But what I didn't realize is this. I was listening to this on my morning walk. This morning was the Appetite for Destruction Super Deluxe Edition. And back in the day, we would probably had to pay $50 for this or something, but now you can get it on Spotify for free. And I was playing through these different ones, and I forgot that they had Heartbreak Hotel in here, which of course, Elvis made famous. So I thought it was kind of funny that, all that music stuff went full circle. So I know my telling music stuff has nothing to do with stocks, and 99% of the folks don't like it, but I want my kids and grandkids to know what it was I was into, and hopefully it will get you guys into some cool stuff that anyone my age knows Appetite for Destruction backwards and forwards, but I know that there's younger folks out there who maybe like just think they're just an old fogey band or whatever. But I got to tell you, I saw them when Slash and Duff finally came back in. It's just sad about Izzy not being in there, and Steven Adler and all that stuff, and it's a very interesting history of how the band worked, and Steven Tyler, the original drummer, being kicked out of Guns N' Roses because of his drug problem. I mean, that tells you how big of a drug problem he had to get kicked out of. I mean, these guys were epic, druggies and drinkers. And of course, Slash is sober now, and as I am, and all that. And I think it's good to be a role model in any way, shape, or form of being not drinking. There's just nothing good comes out of it, frankly. It's just think about that. Listen to. I would suggest, if you do drink, that you watch some Andrew Huberman Lab podcasts on alcohol and what it does to you, and I think you'll reevaluate, because as much as it's fun, man, I miss drinking, especially when I'm at concerts. It's weird being there sober, but it is, man, if you want to live as long as possible, just think about it. I'm not one to preach. Just think about it, research it. There was no one who could have told me not to drink until I had to. I'll do an episode on that, because it might help folks and just go through my journey and my why I am. Now all I drink is, unless it's like a protein shake, all I drink is water. I'll add lemon or lime to it, but water and black coffee. Period. Nothing else. So I tend to be about hardcore, but when I do something, I just do it all in, like kind of this 3 hour episode. So this is was our very important episode on follow through days underneath the 200-day, blending in the 21 day and your low being above your 21 day for 3 more days. I hope you go back and listen to this a few times, but go back and listen to the 21 day and the normal follow through day. And frankly, I mean, you know, if I was charging for this, I'd have to charge a lot. Like, I'm giving this out to you for free, so please share it with folks. Like, I want to get this out. I look at the number of views. I'm like, my God, people just don't, I think people look at something that's free and they equate it as being cheap. Like, if you give something away, and I think that's the same thing with albums and stuff out there now, is people like, oh, like Kenny Wayne Shepherd, who's right there, just came out with a new album last week, new blues album. And it's really good, but like, I think people like, you can just get it for free. So you don't even think um, to go listen to it. And so I think that's kind of what this is about, is like, people have never just given away intellectual property like this for free, but I don't own any of my intellectual property, and people have made tens of millions of dollars off my intellectual property without paying me a dime. And so I'm like, yeah, it's I could die tomorrow, so man, I might as well share what I have. I mean, you can't equate yourself to anybody, but like, what if Livermore hadn't done? Like, no one is in the camp with Bill and Livermore. No one. Like, even like, you look at the richest guys out there, like a Jim Simons. Well, he's passed. Ed Thorpe, who I'm a huge fan of, or the Stevie Cohens. Like, these people are billionaires. Like, not little billionaires, like real billionaires. Like, um, that what if, and like Ed Thorpe, you should read Ed Thorpe's book. Huge fan of him. But Jim Simons never gave out. Jim Simons, one of probably the most successful hedge fund ever, and he kept everything a secret, and never shared anything. And he was the best, objectively the best there is or was, way better than Bill and Warren Buffett and Livermore and anybody, just based on returns and everything. But he never shared it. Like, you read the book on him, and you don't get a damn thing out of it, because he never gave anything away. And so luckily we had Livermore do Reminiscence of a Stock Operator, and then How to Trade in Stocks, right? And then you had Bill, who blessed us with putting out his stuff. And now these people are up here. And so any one of us that are way down here, like I'm way down there, just some random dude, like, share it, and share it and help others, and go out there and be kind to someone in any way, shape, or form. And this is my version of being kind, like putting this information out there and trying to help people, because I wish I would have had this, and I hope it helps people. So please share this with as many folks as possible, because it's very discouraging to see that there's really not that many views, and I'm not sure. I guess it's just too long. I don't know, but this one didn't help. 3 hours and 2 minutes. So see you guys. Peace out. Till next time. I'll make the next one short because this is way too freaking long. See you guys. Bye-bye.